I really thank you for the feedback and the encouragement which we received on our previous webinar. It's just 11:03. We'll wait for a few more minutes. A lot of people are still joining in. In meanwhile, in the chat, you all can just write exactly what is your expectation from today's session. If you have any specific things to know in direct stock portfolio building, or anything to look at in companies which you want us to address, any challenges you face when you are trying to build your equity portfolio, you can just put it in chat, and over the next 2 hours we will try and answer all that questions which you have. Okay, a lot of people in the chat are asking me that is there any link to the previous webinar? So there is a link to previous webinar. Maybe towards the end of this session, we will post the link for previous webinar. And today we are doing a recap of the previous webinar also. At least the basics of fundamental, of the basics of portfolio building, and what fundamentals to look at in a company. We will be doing a recap of that today in the first half. So for a lot of people who've attended the previous webinar, maybe today it will be a little repetitive in the first half, the first 40-45 minutes. But in the second half, we are doing completely two new sectors and companies. So you all can just wait. We've added a few more new slides in the first half also to substantiate whatever we discussed last time. And from your feedback, that you wanted us to incorporate a few more things. So we've done that changes in the presentation. Okay, so I'm seeing a lot of people are asking that what are the multi-bagger stock for this year. So I want to just reiterate that the whole purpose of these webinar is purely educative. So we are basically giving you all that basics which help you to select stocks yourself. With this knowledge, I'm very sure if you start implementing it, you will be equipped enough to pick multi-bagger stocks. And I think we will be discussing that with examples today in the second half. Okay, a few people are asking specific questions to a few stocks like Mindtree, Tata Power, Tata Steel. So these are like, I'll say, specific to the companies. Whatever criteria we are talking today, just go and apply it on those companies, Tata Power, Tata Steel, JNK, and you will be able to get the answer yourself whether these are fundamentally strong companies or should they be in your portfolio or not. A lot of people are saying that can you improve the audio? So I think hopefully the audio is better now. Okay, thank you so much. I think now people are saying that audio is okay. I think we are good to begin in the next 1 or 2 minutes. Okay, someone is asking our views on investment styles such as growth, value, momentum, dividend. So I think when we will be talking about the basics of portfolio building and what stocks to select or when to buy, we will try and address what do you mean by value investing or growth investing. We will like try to touch upon that because the content is too vast. We are giving you all 3 stages and 9 steps in which you can build your own equity portfolio. So the content is too much. So we really can't cover a lot of things, but in the future webinars, based on the feedback which you will give us, we will come up with new and new topics. Some more people are asking that how many stocks should be there in one's portfolio for long term, and I am doing a stock SIP on monthly basis. Any stock thoughts? So I'll say, Mr. Rahul, you are doing perfectly good. In fact, in the presentation, in the basics of portfolio building, we are talking about the right way to build your equity portfolio is via a stock SIP. So you're doing perfectly good on that. And how many stocks to have in the portfolio, we will be covering that, in the next 10-15 minutes. Uh, Mr. Milan Shah is asking that how to navigate from so many calls on various TV channels, newspapers, magazines. So I'll say that have these are all places from which you can get ideas about stocks. Then you should do your fundamental study on that. Given like whatever principles we share in this presentation, you can pick up that principles and do your study on the ideas which you have generated through newspapers, magazines, TV channels, and then select okay, these are the 15 or 20 businesses or 10 businesses, whatever you're comfortable with. You are comfortable to have it in your portfolio, and that is how you should be building your portfolio. It shouldn't be because you got a tip from somewhere. I'll say that these all places will help you generate ideas. Then your fundamental study on that ideas will help. Okay, a lot of people are saying that they were not registered for the part one. So there's no problem. We are doing a recap of part one because today there are a lot many new people who have registered and are going to be attending this. Someone is saying that will you provide any study material after the webinar? So we will be giving one link during the webinar. You can fill up that link and we will be sharing an ebook with you. So this whole webinar we've summarized into a short book and we will be sharing that ebook with y'all. So whenever we post that link, y'all can just fill up the details and the ebook will be sent to you. I think we are good to start the session now. I'll just introduce my colleagues on the panel. So we have today Mr. Hardik Mer, who is my colleague who heads research at Finovate. He is a chartered accountant and a chartered financial analyst, and the stock presentations which you will see on Pidilite and Godrej Consumer Products have been researched and put through by Hardik. I have the other co-founder of Finovate, Mr. Naveen, who is on panel today, and he is the one who's helped us put the content for the first half of the webinar together. I have my colleague Jignesh, who is a certified financial planner, and basically he helps people make a plan which helps them to get financially free. And I have a few other colleagues, Harsh, uh, Rupakshi, Sushil, who are all on the panel, who basically help with financial planning for a lot of people. And we have Mr. Pranav, who is the one who has put through this entire webinar together for us. So I would want to welcome all my colleagues, and I think we are good to start the webinar. When I'm beginning, again, I want to just clarify that this webinar is just purely for educational purposes. It's not to be construed as any kind of recommendation from Finovate or any stock which we are recommending. Whatever stocks we will be talking about, they are just for illustrative purposes. So the first half, we are going to share some principles based on which you can build your equity portfolio. And in the second half, we will show you how you can apply that principles in real life cases or in real life companies. Okay, so the examples of stock is more from an illustrative purposes. So just moving on, myself, Nehal Mota. I am the co-founder of Finovate, 18 years of experience in financial services. I am a postgraduate in management from Mumbai University and MDB from IIM Indore. Very recently, I was a part of the 40 women entrepreneurs selected by Goldman Sachs in IIM Bangalore for the Women Entrepreneurship Program. So that's all about me. Going ahead. As I said, I've already introduced the team. We have Naveen, Hardik, and Pranav, my fellow colleagues today on the panel who've brought together this entire webinar for us. Yeah. So just starting, a lot of people have registered for this webinar and a lot of new people have registered. So it brings us to this fundamental question that we earn money, we spend money, and whatever is left, we save. But there is a difference between saving and investing. When you save money in fixed deposits or in saving banks or liquid funds, you are basically just saving. The money is not growing or beating inflation. So the only reason why we invest, why we convert our savings to investment, is to beat inflation. Okay, so that's the fundamental reason why we're doing this series of webinars where we want to empower people to be able to move from savings to investing and in assets which they think are like risky assets. So over the next 1 hour, you all will understand that how do you take risk out of investing in risky assets. So moving on, today we will be talking about a framework which we at Finovate have made, for building your equity portfolios of wealth creating companies. So moving on, like I said before, that the Finovate's framework is divided in three stages. The first stage is you get your foundation to build your equity portfolio right. The second step is how do you select businesses or companies. The third is, I'll say, the power of compounding or the patience or the long term vision which you need to have when you're investing in equity. So there are three stages: foundation, stock selection, and compounding. And each of these stages, there are a few steps which you need to go through. And if you follow these 9 steps to the T, and probably just mark today's day and time, and probably after a decade, when you revisit, once you've implemented these 9 steps, I can say that you are on the path of creating wealth via investing in direct shares. So moving on, the first step in foundation is getting your asset allocation right. In the last 18 years, we have looked at many people's portfolios, and what we saw that people are either too heavily invested in fixed deposits or real estate or gold, and very little in equity as an asset class. So even though our markets have been giving very good compounding returns, people have never benefited out of it because they are not getting their asset allocation right. So when you decide to begin investing in equity, what you need to understand, that what is the amount of money which I will be allocating to equity. So broadly, when you start investing, there are four major asset classes: debt, bullion, real estate, and equity. So on the left too, the debt and bullion are generally, they give you return over a 25-30 year period, inflation plus 1%. And I will say debt is more to like park money, and it's more like savings. But when you come on the right side, which is real estate and equity, these are assets which I can say is a riskier assets, but given the risk, they also give you more reward. So on a long run, on a 25 to 30 year period, real estate gives you inflation plus 3% and equity gives you inflation plus 7%. Now, looking at this slide, it is so obvious that we should be investing in equities. But like I said, that Indians, majority of our investments are either in fixed deposits or in gold and in real estate. And I'll say very small percentage goes towards equity. So now let's look at in numbers. Say if you would have invested 1 lakh rupees in 1979, if you would have done a fixed deposit in 1979 for 1 lakh rupees in 2021 at the compounding rate of 8%, last 35-40 years, fixed deposits in India have given a compounding return of 8%. So your 1 lakh today would have been 24 lakh 85,000. If the same money you would have put it in gold. So gold in 1979 per tola, the price was 937 rupees. Today it is 48,000 rupees. So the CAGR return in gold is 10.12. So 1 lakh invested in gold would have been 56 lakhs today. If you would have put that 1 lakh rupees in 1979 in real estate, so we have taken an example of the prime real estate in Mumbai, is Samudra Mahal, a property in Worli, which is like a prime location. In 1979, per square feet cost was 700. In 2021, the per square feet cost over there is 1,25,000. So the CAGR return in real estate is 13.48. So 1 lakh invested is close to 2 crores. Now we come to equity, where if you would have invested 1 lakh in 1979 when the Sensex started, today the Sensex is close to 49,000. The CAGR return is 16%. So your 1 lakh would have been 5 crore 48 lakhs today. Now, it just looks like a small difference. How much a 13 and a half and a 16 can make a difference. But when I look at in terms of the numbers, a 1 lakh becoming 2 crore and a 1 lakh becoming 5.5 crore, that's the kind of difference even a few percentage points in returns can make over a period of time. So the power of compounding really sets in after 12, 15, 20 years. And that's where it makes an exponential difference in the overall numbers. So again, coming back to this point that looking at this slide, we all should be investing in equity. But what stops us investing in equity? Because at times we really don't know how to build our equity portfolio, or we really don't know how to approach equities. So, like I said, that there are many ways in which you can invest in equity. One is you do mutual funds. So you can do an SIP of as small as 1,000 rupees a month. You can also build a direct stock portfolio. So today's presentation, we will focus on how to build the direct stock portfolio, but you can also do PMS. The minimum ticket size is 50 lakh. You can do an alternate investment where the minimum ticket size is 1 crore, or private equity, which is again 1.5 crore and above. So there are many ways in which you can participate in equity markets. As a beginner, probably you can start with mutual funds. But as in when you spend 3 or 5 years in equity markets investing via mutual funds, you've seen the ups and downs. You should start your study to look at investing in direct stocks. So how you go about investing in direct stocks. So moving on, why should you invest in direct stocks? Again, the only objective why we should invest in direct stocks is to create wealth, which will happen over a period of time and not really for short term gains or short term returns. And with examples, we will demonstrate to you in the later half of the presentation that how, if you've held on to a company for 10, 15, and 20 years, you could have created tremendous amount of wealth. So the only objective why you should learn about how to build your equity portfolio or why you should invest in direct stocks is that is one way to create wealth. Like I said, that we are very good in our profession. We become experts in our profession. We are very skilled and we earn money. That's one way to become wealthy. The other way to become wealthy is that we start a business. The business does very good. Again, we have that skills to run the business in such a way that it grows a lot, and we are making a lot of money via that business. But all of us don't have that time, expertise, and energy to start that business. So why not look at other profitable businesses? Look at leaders who are skilled enough to run those businesses, and we invest in the shares of that company and we participate in the growth of that company. So the only reason we should be building the direct stock portfolio is that it helps you create wealth. It can offer you returns which are higher than inflation, and again it offers you liquidity. So like I said, that real estate is a very good investment. But again, the question is that when I have to sell a property worth 1 crore, 2 crore, I have to find a buyer. The transaction may take 2 to 3 months to go through, on all the formalities. So it's not as liquid as we think of. Whereas in direct stocks, you have all these benefits. Okay, so moving on to the next slide. Now I come to the most important part in the foundation stage. When you are building your equity portfolio, the step one is get your asset allocation right. So you decide that if I am annually saving, say 3 lakh rupees, just an example, out of which I will save 10% in fixed deposits for my short term goals. I'll save 10% in gold, just as a hedge in the bad times. I decide to save, say, 20 to 30% in real estate. I have bought a property and I'm paying EMIs. And the fourth component, I have now decided that 30 to 40% of my investments will be in equity. Now, out of the amount of investment which I have decided to put in equity, I will decide that how much will be in mutual funds and how much will be in direct shares. So what you need to decide is what is that amount of money every year you will put in direct shares and that amount you have to divide on a monthly basis. So now it comes to this question: when people are investing in direct shares, they are always confused about whether they are trading or they are investing. So I will say that be very clear about your objective of coming to direct shares. Do you want to trade or you want to invest? So I'll say traders are people who are looking at a quick profit. They want to enjoy short term gains. It's a little higher, riskier kind of an investment, and trading is like a full time profession. Okay, so you really need a lot of time. You need to understand technical analysis, chart, patterns, all that when you are trading. So there's nothing wrong with trading, but I'll say that it's a skill, and you need to be knowing that skill. You need to understand what is stop loss, what are targets, what is trailing stop loss, and you need to learn technical analysis when you're trading, and then have a system in place for you to trade. That out of the amount of money which I will be putting in equity, maybe 20 or 30% is a capital which I have set aside for trading, and on that capital there is a target stop loss. So I have put a system in place to trade. Today's presentation is more focused on people who want to invest in equity and who want to build a long term equity portfolio. So, this is more for investors who will do a basic study, and they will invest in good companies and track that companies and stay invested for a longer period of time. So today we will actually be spending time on how do you invest for long term. So you have to decide what is your goal when you are starting to build your equity portfolio. Do you want to trade, or do you want to create wealth over a long run, which will happen by understanding fundamentals of investing for long term? It will happen by value investing. And in the next few slides, we will actually look at what steps do we need to take to be building a wealth creating portfolio. So I'll say that why we should be investing for long term, again, because stocks have the potential to give us returns more than the saving banks rate and also beat inflation. Yeah, so moving on to the next slide. Again, like I said, that trading is your choice, but we recommend that you invest in shares for the long run. And why you should be investing in long run? Because power of compounding works for you in after 12, 15 years in the long term. Long term investing is a little less stressful. You don't need to every day look at your portfolio and see the price going up, down. If you have done a basic study while selecting that company and you're tracking the quarterly results, then you really don't need to sit on the screen every day and watch prices or watch your portfolio on a daily basis. In case if a COVID happens or a subprime happens, you won't like be on streets when you're investing for long term. In fact, any dip more than 25 to 30% is an opportunity for a long term investor to add to the good companies which he already has. So it's a little less stressful. And again, when you invest for long term, you don't take emotional decisions about investing. You are investing with logic, with rational, with data, and not with your emotions. And so we recommend that when you are trying to build your equity portfolio, build it with a vision of long term. So moving on to the next point. So how do you get started in building your equity portfolio? Like I said, please don't invest random amounts. In the last 18 years, when I have looked at many people's portfolios, what I realized, when did they start investing in equity? In 2007, when the market was at the peak and there was an IPO of Reliance Power. Everybody in the world wanted to open a demat account and participate in the Reliance Power IPO. In fact, maximum number of demat accounts got opened just before the subprime crisis. And people made random investments. So if IPO came, they invested. Or if they got a tip somewhere, they invested. There was no fundamentals or structure or basics to their investing. So stop doing random investments. Then what do you need to do? You need to actually decide on the amount of money which you will be putting in lump sum. Say you can say after this presentation, you're confident to start building a direct stock portfolio. Then you decide that I will start my portfolio with a 1 lakh capital, 3 lakh, 5 lakh. It could be any number. It doesn't matter. So decide on a lump sum, fix an annual amount. So again, we don't recommend one-time investment in market. You could start with a 1 lakh, 3 lakh, 5 lakh, but you need to decide every year, like I said, out of the asset allocation, what is the amount of money which you will be putting in equity? That annual amount you divide in SIPs, stock SIPs, and invest every month. So how do you get started? Decide on a lump sum, fix an amount to be invested every year, invest that annual amount via SIP in stocks. Okay, so just moving on, again, like we said, you have to take a pledge today that you will not look at your portfolio on a daily basis. You are not going to stop investing if there is a COVID crisis again, or something like a subprime again, or when the stock markets fall. You have to take a pledge that if I have started investing in stocks, I will invest for a period of 10 to 15 years, irrespective of markets going up and down. Markets will do what it does. What you have to do, you have to take a pledge to be disciplined in your investment every month in stocks. When people do a mutual fund SIP, they like fix 1,000, 2,000, 5,000, 10,000, whatever is amount. Or I'll say when you pay EMIs, irrespective of interest rate going up or down, you pay that amount of EMI for the next 15 or 20 years. So when you're building your stock portfolio, you have to think of that also like an EMI, which you are doing in direct stocks for the long term 15 or 20 years. So you have to decide on an amount and invest it systematically every month for the next 10, 15 years. So the step one was getting your asset allocation right. Step two was deciding the lump sum or SIP which you will put in shares every month. The third step, it is the basics of portfolio building. Now, this is a very important step because again, in the last 18 years, when we looked at people's portfolios, we saw that mutual fund portfolio was compounding at 14, 15% plus. But when we looked at their direct shares portfolio, it really was, I'd say, not giving a compounding return which markets was giving. So what was the reason? We tried to dive deep into what was going wrong in people's direct portfolios. And what we realized is that there was no structure in the number of companies they bought and the amount of money they invested in each company. So I'll say the first step in portfolio building is equal allocation. So for example, you decide to build a 20 stock portfolio. In that 20 stock portfolio, between 5 to 8% should be the amount of money which you invest in each company. You don't have to, for example, if some stock is falling, people will keep on averaging it down, not looking at the reason why it is coming down, whether only because the P is changing, the stock is coming down, or it is coming down because the company is not doing good, and they just keep on averaging. Okay, so I will say that put a structure to your portfolio where you decide that these are 15 or 20 companies where I will invest, and I will commit equal capital in this 15 or 20 companies. And to put incremental capital, I will decide after I see the company's performance for a few years. So I will say with an example that say we are having a capital of 50 lakh rupees, just an example, and there are five CEOs in front of us who say, okay, give me 10 lakh rupees for my business and I will give you a good return. Okay, so there were five CEOs. After 1 year, we go to the CEOs and ask, okay, can we know how your business is doing? So the CEO one, has lost money. His business is not done good. The CEO two has done okay. The CEO three has done okay. Four and fifth have performed very well. In fact, they committed an X amount to the business and they really overperformed. So now, as in person, if in the second year all these five people were going to ask me for more money, I will definitely not give money to the CEO one and two. I will probably put more money, I'll give more money to the CEO four and five, because whatever they had projected for their business, they did better. But in real world, in stock market, what people do, if they have put money in five companies, and if company one and company two doesn't do well, they will put more money in that companies to average. And company four and five, where they made a lot of profits, they will sell that companies and they will take the profits out, and that money they will put in one and two. So we really think very differently when it comes to stock investing versus a real world investing. So when you are investing in stocks, you have to look at it that I have put my money in these 15 or 20 companies. I will look at the performance of these companies, this management, this CEO over a period of time, and the companies which are doing good in future, my next year annual investments or SIPs will go in companies which are doing good and not in the companies which are doing bad. So I'll say that the next step in your portfolio building is getting equal allocation. Pranav, can we move to the previous slide? Yeah, one before that. Yeah. So now, again, another mistake which people do is that they will, harp about those 4 or 5 companies where they have lost money or which are in red, and the companies which are in green, and they are worried about the red ones and they forget the returns which the green ones are giving. So I will say that when you're building a 20 stock portfolio, it's not necessary that all the 20 companies or 15 companies, how much ever companies you've selected, will do good. How much ever fundamental research we do, the market is very dynamic, the business is very dynamic, there are too many disruptions happening, so it's not necessary all our companies do well together. So I will say, I've given an example that bucket one, if you had 5 companies which were like the companies in the bucket one, Pranav, you can take your cursor to the bucket one, previous slide, yeah. So you had 5 companies which gave you 25% return. You have bucket two, which have 5 companies which are giving you 15% return. You have bucket three, 5 companies which gave you only 10% return. And there were 5 companies in bucket four where you lost your capital. You put in company and it became zero. Like, a lot of people had invested in Vodafone Idea sometime back and the stock fell. Syntex, the stock fell, or Suzlon, or a few companies like that. When they had bought, they thought these companies were good, but for some reason the companies became zero. But does it matter? Now what happens, people really focus completely on this bucket four where they are losing capital and they feel that stock market is bad or I'm not doing good in my stock investing, because they are looking at that red or those 5 companies. You have to look at your equity portfolio in totality. So we've given an example that if you had put 10,000 rupees in those 5 companies in bucket one, which gave you a 25% CAGR, at the end of 10 years, your fund value, your 50,000, would have been 4,65,000. If you would have invested 10,000 in 5 companies, that is 50,000, which would have given you a CAGR return of 15%, the fund value at the end of 10th year would be 2 lakh rupees. If you invested 50,000 in companies which gave you 10%, your fund value at the end of 10th year would be 1,29,000. So overall, on a portfolio level, again, the fourth bucket where you put 50,000, you lost the entire money. It is zero. At the end of 10 years, you lost your capital in that companies. But overall, on a portfolio level, you invested 2 lakh rupees. That 2 lakh rupees, the fund value at the end of 10 years is 7 lakh 97, almost 8 lakh. That is a compounding return of 14.83%, which is excellent, which is like almost double of what the bank is giving you, almost double of inflation. So you should be happy. And this is how you should think when you're building your equity portfolio, not focus on that bucket four where you're losing capital. And, understand that when you're building a portfolio of 10, 12, 15 companies, you will get 3 or 4 companies where you may lose capital. But if you get 4 or 5 companies of bucket one, which are compounding at 25%, overall, you will still do very good. Okay, so this is another basic of portfolio building, that equal allocation to companies and a return on a portfolio level and not on individual company level. You have to track the CAGR of the portfolio. So moving on, I'll say that what you need to avoid, don't make these common mistakes while buying, that you buy stocks which are at 52-week low. That's not the right way to think. Buy stocks which are fundamentally good, irrespective of market levels and all. Maybe you should look at valuations, but in the subsequent slides we will say that it doesn't matter in the long run. Avoid buying penny stocks. It doesn't matter if the stock value is 10 rupee, 100 rupee, 1000 rupee. It is a money which you invested. Last time I gave this example that MRF stock is at 90,000, and if you want to invest 1 lakh, you will get one share of MRF. Okay, and in case if you bought some another company where the share price is 100, so 1 lakh, if you invest in a share price of 100, you get 1000 shares. Now that 100 rupee share, if it becomes 150, okay, your 1 lakh becomes 1 lakh 50,000. But if that MRF share of 90,000, if MRF does well, and in 3 years, if the earnings of MRF triples or doubles and the share price doubles, your 1 lakh in MRF will become 2 lakh rupees. So it is the money which is compounding and growing, the I'll say the price of the share really doesn't matter. Again, never buy stocks based on the recommendation of TV channels or reports, or because some HNI is buying, or because your broker has recommended, your friend has recommended. These are all the sources through which you get ideas. Then you need to do your own study and basic study, which we will cover in the stock selection, and then decide to buy that stock in your portfolio. Again, people say that buy only brands. It's not necessary that you buy brands. I'll say Syntex is one example where in the water tank segment, it was a very old brand. In fact, wherever we go and we see water tanks, it belongs to Syntex, but company took a lot of debt and it went into issues. So in spite of being a brand, it didn't do well. So only criteria why you should be buying is the fundamentals of the company and not the other reasons which we really think about. Okay, so moving forward, what are returns? Now, I said that you have to look at returns on a portfolio level and not at the individual stock level. So, what kind of a returns do you need to look at? So, I will say if my investment returns is 25% over 5 years, then the average return is 5%, but the CAGR return is 4.5%. So, generally, we will say that you look at the CAGR or the CAGR return on the portfolio level and not at the individual stock level. So how do you differentiate between what is absolute return, what is average return, what is CAGR? So we've given an example that if you invested 10,000 rupees and you did a bank FD, which gave you a compounding return of 8%. So the CAGR was 8%. After 5 years, your FD will return you 14,600 rupees. So 10,000 at 8% compounding after 5 years is 14,000. So absolute return is 47% because 10,000 became 14,000. So 4,600 was your gain. So absolute return is 47%. Average return is 9%, but the CAGR return is 8%. You can also look at IRR and XIRR, but for the sake of simplicity, we've put at a compounding return because people understand compounding return. When they put money in bank in fixed deposits over 5 years, they get an X rate, which is a compounding rate. If they put in PPF, they get a Y rate. Again, it's a compounding return. And so for simplicity purposes, we've put that when you're building a stock portfolio, focus on the CAGR return on the portfolio level. Okay, so moving forward, again, I'll just summarize that the foundation in your equity portfolio building is getting your asset allocation right, decide the amount of money you will invest in equity, decide the lump sum, the annual amount, and an SIP, and take a pledge that this amount you are going to invest for the next 10-15 years, irrespective of market levels. The third was basics of portfolio building, where we spoke about number one was equal allocation in whatever number of companies you decide. So if you decide to build a 10 stock portfolio, then about 10 to 12% in each company. If you decide to build a 20 stock portfolio, then probably 5 to 8% in each company. And second is what returns to look at. You have to look at the portfolio level CAGR returns. And the third thing, how much ever research you do, and if you build a 10-15 stock portfolio, not all companies will give you returns. So like I said, bucket one may give you very high returns, bucket three will give you average, and bucket four where you will lose your capital. But it doesn't matter. Overall, on a portfolio level, still you will do good if you follow the basics of stock selection. So now we come to the next and the most important part of this entire presentation. I'll say the stock selection. So now you have decided to put money in equity every month. What kind of shares or what kind of companies will you pick up? What will you look at in fundamentals? So I'll say that fundamentals are divided in business parameters, financials of the company, valuation, and management. Now, this is too much data. As a common person, can I really understand, price to sales or price to book value or PEG ratio or EPS and all that? So that's like a lot of data. So in the subsequent slides, we will tell you that out of all this, just 5 or 6 things which you can pick up and you can apply, while selecting the businesses. So in the business parameters, we get the market share, we get what is a product and service of the company whose shares you're buying. Does this company have any brand? Is the sales of the company growing? The only reason why you should invest your money in the shares of any company is because its sales is growing and its profit is growing. If its sales and profit grows, then its stock price will grow, and that is how you will get a return. Okay, so in business parameters, we look at market share, products and services, brands, because companies which have brands, they will have higher sales growth, better profitability. We look at operating profit margin and earnings per share. In financials, we look at what is the debt to equity, and generally we want to focus on companies which are debt free, because as common people we really can't track the markets very actively. So we want to really build portfolio of companies which are very resilient in bad times. If a COVID happens again, or if a subprime were to happen again, these companies are not going to be that impacted. When will they not be much impacted? When they have not taken too much debt. So we will look at companies where the debt to equity is less than 1 or zero point 0.5, or probably debt free. Return on equity and return on capital employed is greater than 15 to 18. Like for example, if I have put 100 rupees in a business, the return which that business should give me should be more than the cost of capital. So if I have to start a business today, I go to the bank and I borrow money. The bank is lending me money at 10 and 12%, 14%, depending on the kind of business which I want to build. So if I'm starting a business, my business should be earning me more than what I'm going to pay the bank back in interest. Okay, so return on capital employed and return on equity greater than 15 to 18, or I'll say a few percentage point higher than the cost of capital. In valuation, we will have detailed illustrations going forward on what is a PE ratio, PEG ratio, what to do if the companies are very expensive. Should we buy, not buy? We will also discuss the management, qualitative and quantitative. We can't really get too much in details in understanding the management, but in shortcuts, we will discuss how we can apply these criteria. So the step 4, like I said, that fundamentals is too much to look at. So if I just want to, in a very short, decide on that 15-20 businesses where I want to put money, the first criteria is look for companies which are debt free, look for companies which are in B2C, so business to consumer. And there are many companies in India which are business to consumer. I will say that in the chat, you can just give me examples of companies which are in business to consumer. So they make a product and the 120, 30 crore Indians are their consumers, and companies which have a dominant market share. So if I am a person who is busy with my day-to-day work and who doesn't have so much time to do research on tracking the sales growth, profit growth, looking at what the management quality is, quantitative, qualitative, and all that, I will apply this criteria that I'll invest in companies which have dominant market share. The reason they have dominant market share, because their management is good, because their products are brand, because they have a competitive advantage, and because of that, many Indians are buying their products and services, and so they have a dominant market share. So when I have put the criteria of a dominant market share, it really filters out a lot of companies out, and I have like a small list of companies which I were to look at. So in the chat, can you all just put examples of companies which are like the business to consumer, debt free, and companies with dominant market share? So I have Mr. Pramod, who has said that Britannia is a company which meets all this criteria. I think you're right. Someone has put ITC. Again, he's right. Someone has put Dabur, HUL. Yeah, you are all right. But all of you all are telling me FMCG companies, Nestle. I'll say think beyond FMCG. Let's look at all other industries where the companies have a dominant market share, they are debt free, and they are business to consumer. So I'll say let's look at the four-wheelers. Can you write in the chat companies in four-wheelers which are debt free, which have a dominant market share, and which are business to consumer? Yeah, some person is writing Maruti. I think you're right when you're writing Maruti. In the four-wheeler space in India, almost 50% market share. You're right when you're writing Eicher. In the I'll say the commercial vehicles and the Bullet and all, they have a dominant market share. Someone is writing Ascots. Yes, in the tractor business in India, Ascots has dominant market share. It is a B2C player. Someone is writing about a few more companies. Asian Paints. Someone has written Asian Paints. So again, this company meets the criteria in the paint industry. Dr. Reddy's, yes, you're right. Colgate, you're very much right. Marico, Page Industries, Cipla. I think everyone here have given the names of so many companies which meet this criteria. So moving on. So now you know how to create a universe in which you will invest. So out of the 5,000 plus listed companies, you have narrowed down now to just 40 or 50 companies which have a dominant market share, which are virtually debt free, and which are in business to consumer space. Now, once you have shortlisted that companies, can we move forward and understand financials? Can we look at the financials? So now in the business selection stage, we have got a universe of companies. Then we go to the financials. So in the financials, what do we need to look at? We need to look at the first thing is the sales growth or the revenue growth. So we have to pick up companies. So out of that 50 companies which you shortlisted, someone wrote Maruti, then they wrote Tata Motors, then they wrote, I think, one or two more companies in the four-wheeler space. So I will look at which is a company whose sales is growing for the last 5 years. Okay, and how much is the sales growing? At least 8 to 10%. What is the inflation in India? Inflation in India is close to 6-7%, and the inflation in packaged goods or in these branded goods is close to 6-7%. So how will my sales growth? Revenue or sales is equal to number of units sold multiplied by the selling price. Okay, if inflation is going up, the selling price is going up. So if the inflation is 7-8%, the selling price is going up by 7-8%. So your revenue is any which way is growing by 7-8%. But for you, not only the price should go up, but the volume or the number of units which that company is selling should also go up. So generally, in the financials, in the profit and loss statement, what you need to look at the last 5 years, the revenue or the sales of that company has to grow by more than 8 to 10%, because that is a little more than inflation. Now the PAT growth, the only way your stocks will give you returns in 10 years is when the profits of that company grow. So if the sales is growing at 8-10%, the profits should grow at 14 to 15%, 12 to 14%. So a 3 or 4 percentage point higher than the sales growth. Because when I was selling 100 units and out of that I was making a profit of 20%. If I sell 120 units, it's not necessary that my cost will go up so much that the margins will shrink. So I'll get economies of scale. If I increase my sales by 20%, my cost will not increase by that much, so my profitability will be better. So companies in the last 5 years where revenue is growing more than 8 to 10%, where profits, PAT, earnings per share, you can name like net profit, these are different names, that is growing at a rate which is a little higher than the sales growth. So if the sales growth is 8-10%, the profit growth should be 12 to 14%. The next number is a return on capital employed or return on equity. So invest in companies where the return on capital employed is upwards of 15 to 18 to 20. Okay, again with example, we will show you many companies which meet all these criterias. Okay, so that's again a cutoff. And the last is a cash EPS growth. Like I said, even in the previous presentation, that a lot of people, a lot of companies will be booking sales. Okay, they'll say before 31st March that I have sold 1 lakh cars. But in the next 3 months, they're not getting that money of the sales in their bank account. Okay, so the cash flow is not matching the sales which they have shown. So how do you actually understand that the books are not fudged or these are not wrong reported numbers? When you look at the cash movement, I can like show wrong sales, but eventually in 3 months or 6 months, if that money doesn't come in my bank account, it's very sure that the sales growth was not right. So one number which will help you to filter out companies which are bad or which are fudging their books and all is looking at this cash EPS growth. Okay, so the cash EPS growth is again the next important number. So like I said, in the stock selection stage, the first step was filtering the universe of 40-50 companies by applying the criteria of debt free, dominant market share, and business to consumer. After I've got that 50 companies, I further look at the revenue growth. So out of that, which are the companies where 5 years revenue is growing more than 8 to 10%, profits are growing more than 12 to 15%, where return on capital employed or return on equity is greater than 15 to 18%, and the cash EPS is growing. Okay, so now moving on to the next, I have looked at the businesses, I have looked at the financials. Now, at what price do I buy these companies, or at what valuations do I buy? So I'll give you an example that how what kind of a thought process we need to have. Like I want to buy gold. I feel gold is a good asset class. It has given a CAGR return of 10% in the last 20, 30 years. Now the question is, should I buy gold today? It's at 48,000. Or should I buy it at 35, 40, or 60? What is the right price to buy gold? That answer no one really knows. What is the right price? So what is the best way to approach it? I know I want to invest in gold. I If the valuations are very high, I will not buy gold in lump sum. I will buy gold every month, 1 gram. And that way, sometimes I get a 48,000 price, sometimes 45, sometimes 50. I will get an average price, which is pretty decent. Okay, so same way, when you're looking at good companies, you may have that these companies are at a little expensive valuation. Then how do you buy these companies? So we will look at some data and numbers as to how do you approach or when do you buy companies if the valuations are a little high. So what do we look at in valuations? Yeah, moving on to the next slide. Stock price is equal to EPS multiplied by PE. Okay, so when you invest in a stock, like I'll give you an example, of one company, Britannia, just an example. If today the stock price is 3,600, 3,600 stock price is equal to EPS. Some component is EPS and some component is PE. Now, I bought Britannia at 3,600. After 10 years, I expect that Britannia should give me a return of more than 15% CAGR, compounding return of more than 15%. How will I get a compounding return of more than 15% in Britannia? By two ways. One is the EPS, earnings or the profits of the company grow consistently over the next 10 years. And the second way is the PE. If today Britannia is at a 60 or a 80 PE, and if the PE expands and the EPS also grows, then the stock price will go up. And that is how I will get return. Okay, so earnings per share is nothing but net profit divided by the number of shares, and PE, price to earning, it's a multiple, it's a number. And what does that number depend on? That number depends on many factors. Companies in US, technology companies in US, they are in this high growth. So maybe people's perception is that technology is the future, and companies like Tesla, Apple, Google, Facebook can get a higher PE because people's sentiment, they feel that these companies will do much better in future. They're sitting on a huge data. Okay, so they get a higher PE. And probably a company which is in steel manufacturing, Tata Steel, or company which is in some traditional business of manufacturing, where people expect that they grow, in a certain pace. So the P those companies get is like 18, 20, 10, very less P. So PE is just a multiplier or a number which is based on many factors like the future growth potential, the sentiments of people, what people think about that industry or that company. Okay, so moving on to the next slide. So what do you do if you get companies with a high P, like for example, Britannia? It's a good company. EPS is growing for last 10 years, but the P is very high. What do you do? Okay, so now we've given an example that if you buy a company where the share price today is 500 rupees, that share price 500 is because of EPS 10 rupees and PE of 50 rupees. This company has a high PE 50. Okay, now if this company's PE becomes half after 10 years, if 50 ka PE becomes 25, but if its earnings are growing at 20% every year, 10 becomes 12, 12 becomes 14. Okay, then at the end of 10 years, because the EPS was growing at 20%, 10 rupee EPS becomes 62 rupees, multiply by the PE, which has become half. So 62 multiplied by 25, the stock price is 1550, which is still a CAGR return of 12%. Still, you bought that stock at 500. Today, that stock is 1550. So the CAGR return is 12%. So you bought a company which was expensive on valuation, but it was a good company. Its EPS kept growing. So if you ask me that what kind of company should you buy? Should you buy companies which have expensive valuation or which are high on PE? I'll say that don't go very wild. Like don't buy companies which are very expensive. Or even if you decide to buy companies which are expensive, buy it in an SIP form. So I will buy, say, 3 shares or 2 shares of Britannia every month. If there is a COVID kind of a crisis which comes again, Britannia stock price fell from 3,600 to 2,100 in the COVID crisis. So it's good. I will buy more at that time. So for companies which are a little higher on valuation, I'll do an SIP. Now, coming to a second example, where people say that we will buy companies with low PE. Is it a good thing to buy companies with low PE? Should PE be the criteria to buy companies? So, look at the second example. In the year one, you invested in a company where the stock price was 200 rupees. The 200 rupees was how? 10 rupees was EPS multiplied by PE of 20. So, 20 PE is not very high. So 10 multiplied by 20, 200. Now, after 10 years, the business did not do well and the EPS came down from 10 to 6 rupees. So the EPS went down by 5% compounding every year. And the because the EPS went down, market understood it's not a good company. So PE also came down from 20 to 10. Now 6 into 10, 60. So you bought a company at 200. Today the company is 60. You have lost absolute 70%. Just because you thought that I'll buy a low PE company. PE is not the criteria. EPS growth is the criteria. So you have to buy companies where you expect the earnings or the profits of that company to keep growing for the next 10, 15, 20 years. So stock price is equal to EPS into PE. So if I invest in a company, say tomorrow after this presentation, you decide, fine, I will build my equity portfolio. I have identified this 15, 20 companies. You have to write down this number that I'm buying Britannia at 3,600 is equal to at this EPS multiplied by this PE. Now, if tomorrow market crashes, what will crash? I want you all to answer that question once I finish the last example. Now let's look at the third example. If you invested in a company in year one where the price was 200, which was equal to EPS of 10 rupees multiplied by PE of 20. Now after 10 years, this company's EPS, this company was like, I'll say not like a very rock star kind of a company. It was a consistently 10% growing earnings or 10% net profit. The company's net profit was growing every year by 10% consistently for 10 years. So the 10 rupees EPS at the end of 10 years becomes 26 rupees. Now the market understands, okay, here is a good company which is consistently growing its profit by 10% every year for last 10 years. So it deserves a better PE multiple. So instead of 20, the PE becomes 40. So 26 multiplied by 40, the stock price becomes 1,042. So you invested in this company in year one at 200 rupees. At the end of 10 years, the company stock price is 1,040. The CAGR return is 18% and the absolute gain is 400%. So how did you get return? You got returns by two things. One is when the EPS consistently grew for 10 years. So the profits of the company grew every year by 10%. And the second reason why you got a good return was the PE grew from 20 to 40. So which is the best combination? The best combination is investing in companies where the earnings are also growing and where there is a scope for PE also to expand. When the PE expands and the earnings also grow, the combination of that will really give you great returns in that company. Okay, so now after looking at this chart, I want you all to put it in the chat that, when the markets fell in March, what changed? When the markets fell in March, I'll give you an example of Britannia. Britannia was 3,600. And Pranav, go to the previous slide. We are asking this question to them. Yeah. So Britannia, I'll give an example. In the month of March, 5th March, the Britannia share price was 3,600. And on 25th March, the share price became 2,100. What changed? Out of this equation, stock price is equal to EPS and PE. Stock price came down from 3,600 to 2,100. So what do you think changed in that 20 days? Yeah, I think a lot of people are getting this right. In that 20 days, EPS did not change. Britannia ka biscuits, even in COVID, people were eating. Okay, so in that 20 days, the EPS did not change, but the PE became very much down. Okay, so if you are an intelligent investor, what will you do? You will know that yes, I want to buy Britannia. I was buying Britannia and SIP every month. Now COVID is an opportunity for me to get Britannia at a very less PE multiple. Because the EPS is not changing much, it is just the P which is become half. So I will buy more Britannia. Okay, so we've given this example in the next slide. I think a lot of people have got this right, that when the stock prices went down in March, what changed? EPS, definitely it would have changed, but not much change in the EPS. There was a big change in the P multiple, which is just the sentiment, which will keep changing and which is not in your control. What is in your control? It is in your control to buy good companies where the EPS or the profits or the earnings will keep growing. So we've given an example. Just see this chart. On 5th of March, Britannia price was 3100. So the stock price was 3100. The EPS was 58 rupees and the P was 53. Now look at this chart, which is 23rd March. Pranam, take your cursor to 23rd March, when the lockdown, when India started going in lockdown. At that time, the stock price of Britannia fell down to 2100. So if you see 3100, say 2100, EPS is the same, 58 rupees. But the PE of 53 became 36. Now, what will you do as intelligent investors who are building this portfolio for long run? You will buy more Britannia in the month of March. I know of a lot of investors who got so worried. Okay, it's again a time like subprime or something, and the companies will keep coming down. So if whenever there was a little pullback, they got out of very good companies. But if you are an investor who is building a portfolio for 10 or 15 years, you know, I was buying this company 2 months back at 3100. What changed in 2 months when this fall happened? The EPS did not change, the P changed. And so I will buy more at 2100. And this is the way you approach, direct stocks and accumulate direct stocks in every dip in the long run. Okay, so hope this answers the question, that yes, valuations is important, but valuations is not the only thing. It may happen that you may buy companies with higher valuations because good companies which have dominant market share, which are debt free, whose sales and profits are growing, whose return on capital employed is more than 15 to 18, those companies will be a little high on valuation. So the best way to invest in those companies is via SIP. And whenever there is a dip, see what is going down. If the P is going down, buy those companies in lump sum in every dip. Okay, so moving on to the next slide. So when should you buy a company? You should only buy a company where you expect the future growth, where you expect the sales, profits of this company will go up. You should look at the competitive strengths of the company. What are the weaknesses? What will impact the future prospects? So you are not buying the company based on past data. Past data is only helping you filter the good companies. But again, what I'm going to look at, is Britannia going to grow in the next 10 years? Is Nestle going to grow in the next 10 years? So in the next second half of our presentation, where we will be doing, we'll pick up all these, I'll say all this, fundamentals and put it in a real life case study of two companies, where we will see that how do we look at future growth, and will this data help us to understand the future growth? Ensure that you do not invest in overvalued companies. So what do I mean by that? When the P is high, okay, you may still invest in companies where the P is high if the earnings are also growing. Like I said, if EPS is growing at 30-40%, then the company can still justify a PE of 40, 50, 80. So for that, there is a ratio called as PEG ratio, okay, where if the P is high, but if the earnings are also growing at a higher rate, I can still invest in that company. So what PEG ratio people are comfortable with? Generally, the rule book says that PEG should be 1. Okay, so I'll pay a higher P if the earnings growth is high. So if the PE is 50 and if the EPS is growing at 50%, I'm okay with that. But in the real life, it's a little difficult to get that kind of company. So I'll say a PEG ratio of 2 to 3 is also okay in a country like India, where good companies are expensive. Okay, so moving on to the next slide, that now you have got your foundation right, you have selected the stocks, you have looked at the financials, you have looked at the valuation, you have bought those companies. Now what to do? Okay, what people do, they buy Britannia at 3600. The moment it becomes 5000 or 6000, oh, my money's double. I got 100% return and they start selling. So now my question is that how do you be patiently invested in the company for 10, 15 years? What should you look at? And why should you hold on to those companies, or when should you sell those companies? So only thing to look at is the you need to track the quarterly results of the companies. So every quarter, the only number which you need to look at is the EPS. I bought Britannia in the month of January 2021 at 3600. 3600 is equal to the EPS of 53 multiplied by the PE of whatever is the PE. Every quarter, I will only focus on how much is the EPS growing. Okay, so the only thing I need to track in my portfolio is not the share price. As I said, the share price will keep changing with sentiments of people, by global factors, political factors, many things. But what will stay, in the long run, or what is one thing which will make the company robust in the long run is its profit growth. Okay, so the number which you will see in the quarterly results is the EPS growth. The next is, yeah, so Pranav, moving on to how do you make wealth? By investing in good companies, and what you should track, the earnings growth. Are the earnings growing, EPS growing? And second is read annual reports, because when you read annual reports, you know how confident the management is about the future growth. How will the EPS grow after 3 years, 5 years, 10 years? What is a company doing to make its profit grow and to make its sales grow? So when you have built a portfolio of 15, 20 companies, as a next step, you don't have to look at the price. You don't have to look at ये company red है, ये company green है. वो तो everyday change होगा depending on market sentiments and all. What you have to see, the every quarter, March quarter results will be out in April and May. What happened to the EPS of that company? That's the only thing which you need to look at. Moving on to the next slide, rebalance. Now, people in many forums ask us this question: when do we sell? Why are we investing in companies to make returns? So, if I got 100%, 200%, I'm happy. Why should I not sell that company? So, I will give you an example. Can people write in chat when was TCS listed, and what was the valuation at which TCS was listed? Can people just write? I think TCS was listed, if I am not wrong, somewhere in 2005 or 6. I think TCS was listed. Okay. What valuations was TCS listed at? I think Naveen or Hardik, if you all have this number handy, you all can just share that number with me. Yeah, that is the stock price, 750, 500. I'm asking about the valuations. I think it was listed at, when it was listed, it was a 10,000 crore company, if I'm not wrong. If I remember very well, it was listed somewhere in 2004, 2005 at 10,000 crore. Now, after listing, just after the subprime crisis in 2009-10, TCS share price from 850 became 1600 or 2000. It doubled. So a lot of people said that market is fully bad, but TCS, I'm getting 100% returns. So 10,000 crore market cap became 20,000 crore. Okay, and so a lot of people sold the TCS shares. Now Ratan Tata has started TCS. He listed TCS at a certain market cap. He is still not selling TCS. He is getting people from IIMs and Harvard and very good management to run TCS. From a 10,000 crore market cap, it became 50,000 crore, 1 lakh crore, 5 lakh crore. Can anyone write the number in chat? What is the market cap of TCS today? I am, if I'm right, the market cap of TCS today is more than 10 lakh crore. Okay. So 10,000 crore ka market cap company became 10 times 1 lakh crore, 1 lakh crore became another 10 times 10 lakh crore. So if you would have bought TCS in 2005-6, and when double triple, when the market cap became 20, 30,000, 50,000, you would have sold TCS. Would you think you would have created this kind of a wealth? So till the promoter of the company, which is Ratan Tata or the Tata Group, they are not exiting the company, why should you exit? If Mukesh Ambani is still investing money in his company, from an oil refinery, it went into retail, it went into telecom, it has gone into many more businesses. Till Mukesh Ambani is still investing in his company, still raising capital, still growing. Why should we sell the shares of that company? Did TCS EPS stop growing? Has Reliance EPS stopped growing? No. So again, don't exit a company because you're getting double, triple returns, or your return is 100 to 100%. The only reason you will sell a company is when the EPS falls more than expected, when the fundamentals of the stock change, and when you expect that in the next 10-20 years, I don't see the revenue rising, but I see the cost rising. Like something which happened in the telecom industry a few years back. Okay, telecom industry went through so much competition with Jio coming in and a few more players coming in, that it really became difficult for the telecom players. The revenue was not rising that much, but the cost was rising a lot to service the kind of user base which they had. So that would be the reason that fundamentally I'm not okay with the telecom industry or with the telecom stock, and then I exit because I don't expect the EPS to go up. Okay, when to average? I have answered this question. Whenever index falls by 20 to 30%. So if Nifty was 13,000 in March, when the lockdown happened, Nifty fell from 13,000 to 8,000. Okay, did the earnings change in 1 month? It didn't change. The P changed a lot. Okay, so whenever you see index falling by 20-30%, your good companies, you go ahead and average or put in a lump sum investment. Okay, so when will you average a stock? When the price comes down because of the change in PE and not because of the change in EPS. So I hope this answers the question that when you should exit a stock. You should only exit a stock when the promoter is selling the company, when their future EPS is not expected to grow, and when the fundamentals of the company change, not because the price has gone up too much, or because my returns are 100, 200, 300% and I actually get out of the market. Okay, that's not the criteria. Yeah, so moving on to the last and the most important thing. How does wealth creation happen in equity markets? Again, I said long term. Decide on good businesses, put a lump sum, put a SIP every month. Whenever there is a fall in index, add more to these companies and remain invested for a period of 12, 15, 20 years. That's where you create a lot of wealth. And how do you create that wealth? I'm running out of time, so we will just switch on. I had to wind this up in 1 hour. I have taken an hour already. So moving on to the next slide, Pranav. You get returns in equity via capital appreciation. Like we took an example, you bought a Britannia share today at 3,600. After 10 years, the share price becomes say 6,000, 7,000, 10,000. So your capital appreciated via the appreciation in the stock price. You get dividends. So good companies pay dividends. So like if you have done a bank FD of 1 lakh rupees and you get an interest of 6-7%. So like interest, companies can pay you dividends. And third, and the only most important factor in wealth creation is passive investment. Don't look at your portfolio every day. Don't look at red and green. Focus on business, focus on EPS, and be passive investors. That is what will help you create wealth. Now, in a few slides, we will tell you how patience pays, or how long term really changes entire wealth creation journey for you. Yeah, so Pranav, moving on to the next slide. This is an example of one person who invested in mutual funds. Okay, he decided he wants to invest in equity, but he was not confident of investing in direct shares. So he decided to invest in mutual funds. So in 2001, he did SIP in 3 mutual funds, and they were not number 1, number 2, number 3. In fact, he didn't even change this funds chasing the number 1, number 2, number 3 in last 20 years. He continued 2000, 2000, 2000, 24,000 a year in 3 mutual funds. So he invested 72,000. Okay, now look at this red line. In 2008, by 2007, by investing every month, he had invested 5 lakh rupees. That time a bull run came and his 5 lakh became 34 lakh rupees. He was gaining 29 lakh and his returns were pretty high, almost like 5 lakh becoming 34 lakhs. So 5-6 times his portfolio had grown. Now this person did not understand subprime crisis or anything. 2008 subprime happened and his portfolio of 34 lakh became half, 17 lakh. Lot of people got so scared of equity investing at that time. They thought, okay, chalo, I put 5 lakh 76, I'm getting 17 lakh, 3 times my money in 8 years. Let me take and run out of the market. But this was a sensible person. He just continued his SIP. He didn't get scared because the subprime happened, and everywhere in the news, in the coffee table, friends, analysts, everyone saying it's bad, it's bad. So he didn't get carried away by all that. He stuck to his discipline of SIP. Now look at what happens. From 2000 comes 2009, he has invested 6,48,000. His fund value is back to 35 lakh again. Okay, so in a year, 34, it was in 2007 that 34 lakh portfolio became 17, but he didn't leave the market. He continued his SIP. He didn't even put more money. Again, that 17 becomes 35, then it becomes 43, then in 33. But you see again, people say that 4 or 5 years, I didn't get any return in mutual funds. 4 and 5 years is not the time horizon when you judge your equity portfolio. Now, this gentleman's portfolio was 43 in 2010. Till 2013, his portfolio is only 45. So 5 years, he didn't get any return. So when we say that market has a compounding return of 15-16%, it is not 15-16% every year. Some year it is negative 50%, some year it's positive 100%, some year it's 10-15, but an average, if you stay invested for 15-20 years, your compounding return average will be close to 15-16%. But in a year which you enter, it's not necessary every year it is 15-16, it could be up and down. But if you stay invested for longer period, it evens out and you get an average return. So now in 2014, when Prime Minister Narendra Modi won the election, suddenly his portfolio of 45 lakh jumped to 71 lakh. He got in that year a 53% return on his portfolio. Okay, now he continued his SIP. Comes 2020, this data is till December 2020. Exactly, this person is now invested for 20 years. He has invested 14,40,000 in mutual funds. Today, the fund value is 1 crore 25 lakh. He is gaining 1 crore 10 lakhs and his CAGR returns is 18%. Now, if this person thought that stock market is very risky, upar ja raha hai, niche ja raha hai, I am really scared or I don't want to invest, and he would have done a fixed deposit. So we've given this last column where if he would have done a fixed deposit which was growing at 8%, then today his fund value would have been 35 lakh. So though in fixed deposit, he would have not seen red, green, plus, minus, all that. But his 14 lakh 40 in fixed deposit would be 35. His 1440 in mutual funds today is 1 crore 25. So this is what we say by power of compounding, by long-term investing. Now this I gave an example of mutual funds. How do I take this example in stocks? I will not get too technical. There is not much time. Again, why did this mutual fund portfolio grow so much? Again, coming back to this, Nifty in 2000 was 1264. Nifty today is, say 2021, the data is not updated, but 2019, it's 12,000 or today it's 13,000. What has grown? Why has Nifty grown or why has index grown? Because the earnings of 50 companies of Nifty was 65 in 2000. Today, the earnings of 50 companies of Nifty is 427. So the index is 9,200 is because 427 earnings multiply by 21 PE ratio. And so index is 9,200. So how do you get returns when you invest in mutual funds or index? Same thing. Earnings multiply by PE. What has changed in the last 1 month? Earnings of Nifty companies have not changed. The PE, 21 PE has now become 40. And so market from 9,200 have gone to 15,000 right now. Okay, so if I were to look at how much has Nifty grown in 20 years, Nifty was 1200, now it is 9,200. So Nifty CAGR is 10.46. And how does this 10.46 come? Because the earnings of Nifty companies, which was 65, has now become 427. So earnings have grown at 9.8 or 10%. Because the earnings have grown at 10%, the Nifty CAGR return is also close to 10.5%. Okay, so this is how index grows, or this is how companies grow. At the end of it, it is earnings growth, EPS growth, profit growth, whatever term you want to coin. Okay, going on to the next slide. In companies, this is the example of Maruti. If you would have bought the share of Maruti in 2008 fall, at that time the Maruti share price was 490. Now the automobile industry in the last 3 years went through a lot of ups and downs, with electric vehicles coming in, with that BS6 norms changing and all. It went through a lot of turmoil. Still today the Maruti price is 7,200. It has grown 15 times in 12 years. Okay, moving on. So this was the power of compounding of patience. This is a company, Asian Paint. 20 years back, the share price was 16 rupees. Today, the share price is 2,400 rupees. In 20 years, this company has grown. You can put a number, how many times? It's crazy. If you would have put like just 1 lakh rupees in Asian Paints 20 years back, today, it would have been more than 1 crore plus in just one company. Just go to the next slide. This is again Eicher Motors, a bullet bike. The share price was 31 in 2000. In 2022, the share price is 2,700. So if people were chasing return, 31 ka share, they would have sold at 60, 100, 200, and they would have missed this entire wealth creation from 31 to 2,700. Just go to the next slide. Again, I see a lot of doctors today on this presentation. So go back to your own industry. You have been writing drugs of Lupin, Ajanta, Ipca, Torrent. These companies have been biggest wealth creators on the stock market in the last 20 years. Almost all their shares, Lupin has grown more than 400%. In fact, last 3 years, Lupin share price has not grown that much. It was 2,000 4 5 years back. It is still 1,000, but still over a 20-year period, it is grown from 2 rupees to 1,000 rupees. Moving on to the next slide. Now, there are many people on this webinar today. So I'm very sure we all of us have used this products and service in the last 20 years. Dr. Reddy's 12 time returns, Godrej 90 times return, Marico 66 times. We don't go and say in the shop that mujhe coconut oil do. We say parachute. The brand has become synonym to the product category. We don't say that give me noodles. We say give me Maggie. Okay, so this is the kind of growth which these companies have given if you were invested in these good companies over long run. And all these companies meet the criteria we spoke: mostly debt free, dominant market share, return on capital employed more than 20, sales growing, profits growing. Every criteria which we discussed, these companies meet. We track quarterly results of that companies, if the earnings are growing or not, and stay invested till the time the earnings are growing. This is a kind of wealth you can create in the long run. So moving forward, I'm concluding the presentation once again by saying the 3 stages. Get your foundation to build your equity portfolio right by deciding on asset allocation. How much of your money will go to fixed deposits or debt? How much will go to gold, how much will go to real estate, and what will come to equity. That amount you decide, annual. Okay, I will put this much amount every year. That you invest in via SIP. Third is the basic of portfolio building. So look at allocating equal amount of money in whatever number of companies you decide. Look at the portfolio returns. Look at the returns on a portfolio level, the CAGR return, and don't look at red and green in individual companies. The next step, how do you go on deciding the companies? Look at in the business selection, companies which have dominant market share, companies where virtually they are debt free or less than 0.1 to 0.5 debt to equity. Third is the business to consumer, because we don't understand capital goods that much, or we don't understand a few companies which are into products and services which we don't use. So I will say that if we really don't want to be active investors, we want to be passive, just buy good companies and leave for long run, then stick to companies which are business to consumer. Look at financials. I have already summarized what you have to look at financials. Debt free, return on capital employed greater than 15, 18, sales growing at 8 to 10%, profit growing at 14 to 15%, valuations, stock price is equal to EPS multiplied by P. So if you get companies with higher P, start an SIP. When there is a dip, see the dip is because of EPS or P. If the dip is only because of P, but the EPS is still growing, invest more in lump sum at that time. The next is tracking. How do I track my portfolio? By looking at red and green, by looking at the value every day, or by looking at the share price? No, I will only look at one thing, which is EPS growth, earnings growth, profitability growth of the companies where I've invested. When do I rebalance? When there is index corrects by 25-30%. Good companies, I will buy at that time. If I'm doing a mutual fund SIP, if index corrects, I will add to that SIP. I will add lump sum at that time. Again, when will I rebalance? When the stock corrects because of correction in PE, not because of EPS. When will I exit the company? When the EPS has stopped growing, or when the future prospects that EPS is going to grow is not there, I will exit the company at that time. And finally, the wealth creation. When do you create wealth? When you remain invested in a company for 8, 10, 15, 20 years, and track the EPS growth, not look at your returns 100%, 200, 500. That will tempt you to exit good businesses. So wealth creation will happen over a period of time. So with this, I come to the end of my presentation. I'll say that you all 300 people I see right now on this webinar, please take this pledge today. When you start investing in equity, I will invest in direct shares every month for the next 10, 15 years. I will invest, I take a pledge to invest in fundamentally good businesses. I take a pledge that I will track the EPS growth of the companies I have invested in. I will invest more money when the market falls by 25, 30%. I will not get scared. I will not run away from the market. I will add more when there is a dip. So I take this pledge. I take this pledge that I will only focus on one number, which is EPS or earnings growth. I will not focus too much on PE, and I will not focus on share price bada hai ki gata hai. Share price is just a reflection of, again, EPS and PE. And the last is, I will sell a company when the fundamentals change, not when the price is up and down. Okay, so this is a pledge which I want all of you to take today when you have attended this presentation, and start your journey of building portfolio of good companies for long run to create wealth. Now, whatever I have spoken, how do you see that in real world? In a few minutes, how do you understand where to see all this data? So Pranav, I would just want you to stop the presentation and go to screener.in, and we will just demonstrate how to see this companies, or where to see this data very quickly. Yeah, just go to screener.in. So by the time Pranav is just changing over, I will say, yeah, so he's come here. Maybe in the chat, y'all can name any company where you want me to show you how to look at this data. Let me take an example of Britannia. We've been speaking a lot about Britannia. I'm not recommending you to buy Britannia, but whatever data points I said, as a common person, can within a few minutes you get all these data points? So I'll say, look at Britannia. The stock P is 47. The stock EPS is 74. So 74 EPS multiplied by P 47. The current market price is 3,500. Now let us look at the first criteria which we said, that the sales are growing. So can you see this company's sales growing? Pranav, go to the profit and loss. Yeah, can you just see 2009, the sales of Britannia was 3,400. From there, it has grown to 11,600. So if you see, the sales for the last 10 years are upwards. Now come to the bottom, net profit. Pranav, take your cursor to this number, net profit or profit after tax. You can call it PAT, you can call it anything. The profit after tax of Britannia was 151 crore in 2009. Today, in 2020 March, the profit after tax is 1400. And if you see the TTM, the trailing 12 months, even in pandemic, its profit has grown from 1400 to 1700. Okay, so I'll say that we consume more biscuits, I think, in pandemic, and so I'm seeing this company's net profit. So does it meet our criteria? Dominant market share in the biscuit category. Second criteria, debt-free company. So I will come at debt-free. Yeah, let's go to the debt-free. What is the debt to equity ratio? If you see debt to equity ratio 0.92, less than 1 or less than 0.5, it is not completely debt-free, but still the debt to equity is less than 0.1, which is okay. Now, return on capital employed. Just see this number, return on capital employed, 37.4. We said invest in companies where the ROCE is more than 15 to 18. This is way above that. Okay, so criteria 1, sales growing met. Criteria 2, profits growing met. Criteria 3, debt to equity less than 1. Criteria 4 was your EPS growing, just go to EPS growth. Pranav, go again to PNL. EPS growth, yeah. So if you see this EPS in rupees, 3 rupees EPS is today 58 rupees and last 12 months 74. So even this criteria is met. Okay. So whatever criteria we spoke about, this is one company which fits that criteria. I'll take one more example and wind up my presentation and invite my colleague where he will do case studies of two companies and demonstrate to you. Okay, now we looked at past data, how to look at future growth prospects. Yeah. Maybe we take one more company, Nestle. Okay, so again, let's go to the first number, dominant market share. Every business which Nestle is in, baby food, Maggie, probably chocolates, and many other categories which Nestle is in, most of the business, it has a dominant market share. It is business to consumer, B2C. Third is debt free. Go to the debt to equity of Nestle, 0.08, virtually debt free company. Go to return on capital employed, 98%. Okay, go to PE. Again, see, the PE of this company is very high, 79. But go to the EPS. EPS is 200 multiplied by the PE of 79. The current price is 17,000. Now, why will we invest in this company if we expect this EPS to grow consistently for next 10 years? So even if the PE is high, I can still invest in an SIP in the stock of Nestle because it is meeting all other criteria other than the valuation, which is a little high. So how do I address this? By doing an SIP. Now go to the profit and loss account. Go to profit, and on a click of a button in one screen, you are getting all the data which we said, which a common person can also find out. So if you see sales of Nestle in 2008 was 4,300. Now it is 12,000. So it is an upward sales growth. If you go to net profit, in 2008, the net profit was 500 crores. Right now, the net profit is 1900 crore. And in last 12 months, trailing 12 months, it is 2000. So it is still grown in the COVID year. If you see the EPS was 55. Now the EPS is 214. Okay, so it is meeting the criteria of sales growth, profit growth, EPS growth, debt free, dominant market share, business to consumer. Okay, so like that, people were writing Tata Power or they were writing many companies. Please go to the screener.in, put the name of the company where you want to get this data, look at this basic data and decide for yourself. Would you have this company in your portfolio for long run or not? Does the company meet all this criteria? Okay, so with this, I would like to end my part of the presentation. We will take a few more minutes, maybe overshoot the time a little bit. I invite Hardik to now demonstrate whatever we discussed in portfolio building by case studies of two companies, Pidilite and Godrej Consumer Products. So Hardik has applied all this on two companies and researched these two companies in details, and this will help you to understand. So towards the end, I'll take a few minutes to discuss what Finovate does. So moving forward, Hardik is equity research analyst at Finovate. He heads our equity research division. He is a chartered accountant and a chartered financial analyst. He's worked with Deloitte for 4 years before he started working with Finovate. So all over to you, Hardik. Yeah, Pranav, can we move on to the next slide?
Thank you, Nehal. Thank you for this introduction. So as we have seen, this was Pidilite's advertisement, and they are very well known for its the kind of campaign they do in the market. So by name of this company, it is possible that you may not know what the company is doing. But if I'll tell you the product of the company, I am sure that every one of you would have used its product. So this company is, if Pranav, if you can move to the product slide. Next. Yeah. This company is into Fevicol, M-Seal, Dr. Fix-It. These are the products which we generally use in our day-to-day life. And this product itself are synonym for the product which they are selling. So if you will go in a stationery shop or Panwala's dukan, you will not tell them to give you adhesive. You will tell them to give you Fevicol. So this is the kind of brand and marketing this company has created in India. Moving on to the first slide. Yeah. So there are mainly two sub-segments within this company. So the company is getting 80% of its revenue from consumer and bazaar product, meaning the product which we use generally in our day-to-day life. And apart from that, the company is also selling B2B product, which is business to business. So the company will sell its product to another company, and that another company will use its product into manufacturing or further processing. So if we take Fevicol as a brand, the adhesive and sealant category, the company is getting 50% of its revenue from that sub-segment. That is the main thing which I wanted you to understand for this company. Now, moving on to the next slide. So let's see how adhesive market itself is doing. So in India, we are expecting this sub-segment to grow at a rate of around 7 to 11% for next 5 years. So this category is giving me uh, a rate of growth which is higher than my GDP growth rate. How most of its product are sold to packaging, construction, and automotive sectors. So this industry is dependent upon how other industry is performing. So this is how we will do industry analysis. Now, which are the main players if you take India as an example? So you will not find any other player of similar size as compared to Pidilite. So then we went on to see which other players are there in the entire world. So there are 3 to 4 other players apart from Pidilite selling similar product, which is Arkema, HB Fuller, Henkel, Sika, but none of these companies are listed in India. Uh, Moving on, these 5 players are controlling 82% market share of uh, adhesive industry. Yeah, the next slide. Now about the company. So this company was established in 1959 by Mr. B.K. Parekh, and since then the company is selling the same kind of product and growing its market year on year. As you all know, Fevicol is very well-known brand name, and within India, within adhesive market, they have 70% market share, and rest all players, being organized, unorganized, unlisted companies, they only control 30% market share of this industry. So as we have discussed in our previous slides, this company is a market leader, so that one point is clear. Now, the kind of advertisement and marketing campaign they have developed. So this company must be spending very high amount in advertisement and marketing, right? No, the company is only spending 3 to 4% of its revenue in marketing. So you can understand the kind of revenue they must be earning by selling its product in the market. Because when it comes to FMCG sector, most of the companies are spending around 10% of its revenue in advertisement. Now, coming to manufacturing facilities. So within India itself, the company has 23 plants, and the plants are located in various locations so that they can supply their material and products to all the parts of India. The company has 30 warehouses and 8 regional offices and 2 R&D centers. So apart from Fevicol and adhesive, which we generally use in day-to-day life, they have different products. It started with adhesive, but gradually it went on to develop a waterproofing segment product. It has developed various other products. And so, how was it possible? So they have done it on their own by doing R&D. If you can move on to next slide.
Hardik, can you just check the internet? Your voice is a little cracking in between.
Yeah, I was disconnected from the internet. Pranav, if you can move on to the previous slide. Yeah, this is about the company. So the company has around 5,000 different kind of product and product ranges. So within Fevicol itself, we have different size of the bottle or different size of packaging and everything. So if we take everything together, the company has around 5,200 different products. The company sells its product to through 13 various channels. Just wanted to check if I am audible to everyone. Nehal or Pranab, if you can confirm.
Yeah, now you're audible.
Okay. So apart from this, the company is selling Feviquick, one of its very successful product, through 4 million outlets. That is 40 lakhs different outlets in which the product is available. They are spread across around 3 lakh wholesalers, and so their supply chain is very
Hardik, we've lost your voice again. Hardik, we've lost your
Am I audible
voice.
now?
Yeah, you're audible now. Okay, by the time Hardik just figures out his internet connection, so what Hardik was trying to say that whatever criteria we discussed in the presentation, here is one company, Pidilite, which is more or less like a monopolistic in its segment. It controls almost 70% market share in the adhesive category. And like if you would have heard him talking about that when we go to a store, we don't say, "Okay, give me glue or gum." We say, "Give me Fevicol." Okay, so the brand has become synonym to the category, and why this company is expected to grow a lot in future. So in the next few slides, he will talk about how the company performed in the past and how is it going to do in the future. So I think Hardik is back.
Yeah. Pranav, if you can move on to next slide. Yeah. So these are various products which we have seen. Uh, Probably these are the product which you have used in day-to-day life as well. Now moving on to the performance. So I have plotted last 5 years data in this first table. So revenue went up from 5,300 to almost 7,300 crore in just 5 years. And if you take profit, profit went up from 800 CR to 1100 CR. They are also paying dividend of around 30% in each year, and the debt to equity ratio of the company is zero. So if you will see the financial criteria which we have discussed in our first presentation, most of the criteria are satisfied. Moving on to the next table, the company has given, if you can see the last line, the company is giving ROE to the north of 25% in each year. So this criteria has also been satisfied. Now, the third table is pertaining to how much growth the company has given in its revenue as well as its profit. So, if you take 5-year revenue, the company has given 8% growth. If you take 5-year profit, the company has delivered 17% growth with average ROE for last 5 years of 27%. Now, the company is generating around 1,000 crore in its profit. So, out of the profit and cash flow generated by the company will pay dividend. Okay. And what the company will do from this profit, it will again redeploy this cash into capex. So the company will invest in new plants, new factories, so that in future also the company will keep growing at the same similar pace. Pranav, if you can move on to the next slide. This is the recent result given by the company. Now, as we all know, the December quarter has already been over. So most of the companies have started coming out with its Q3 numbers. So if you take revenue, this company has delivered 20% growth rate over its past year's similar quarter, same quarter. If you take profit before tax, the company has given 30% growth. Growth. Moving on to the operating performance, the company is currently operating between 85 to 90% capacity of its production. So, in all the factories that the company owns,
We've lost your voice, Hardik, and I think there is a lot of disturbance in the internet.
yeah, I'm not sure why is it happening. It just started recently in last half an hour. Just wanted to confirm if I'm audible to you.
Yeah, now you're audible.
Okay. So uh, we were talking about the operating performance. So all the factories are operating at 85 to 90%. Now, what the company is doing? The company is doing two things. One, it is investing its money into its existing capacity to build its existing capacity so that in future also the company keep growing at the same pace. Second, the company is also investing in purchasing new companies in the market to enter into different products different from its existing product. So to give an example, the company recently acquired Huntsman, which is selling adhesive in the market under the brand name Araldite. I mean, some of you would have heard of it. Araldite is also a well-established company, and the Pidilite company has spent around 2,000 crore to purchase this company. So the company is investing in its existing capacity to enter into different
I think, Hardik, we are losing your voice again and again in between. It's like not coming stable. Okay, I will just summarize what
Am I
Hardik was
audible
trying
now?
to say. Yeah, you're audible now, but after a few words, again, we lose your voice. Again, it's coming back. It's not stable. So I will just, by till the time Hardik just fixes the audio, what I'll just summarize what Hardik is trying to say. that here we have a company Pidilite. Pranav, if you can go to the previous slide, I'll summarize till Hardik is fixing the audio. If you see the revenue, 2016, the revenue was 5,300 crore. In the last 5 years, the revenue has grown from 5,300 to 7,200 crore. Profit has grown from 800 crores to 1,100. And the debt to equity criteria, zero, completely debt free company. And return on equity, upwards of 27, 28, 24. Okay. And if you see the 5 year revenue growth, we had said that generally look at companies where the revenue is growing at 8 to 10%. So this company's revenue for the last 5 years is growing at 8.5%. The profit is growing at 16%. So we had said profit growth 3, 4 percentage points higher than the revenue growth. The average ROE is 27. Your ROE and ROCE is almost similar because this is a debt free company. So we have taken ROE. The price CAGR, Pidilite's price, share price in the last 5 years has grown at a compounding rate of 24%. And the free cash flow to PAT, how much cash, free cash is it generating after paying for all expenses? It is 74. Okay, so this is what Hardik was trying to summarize in this slide. I think now you can check your audio. If it is good, you can continue the presentation. Yeah, move to the next slide, Pranav.
Yeah, sure. So am I audible now? Is it clear?
Yeah, it's better. Yes.
Or else I'll do one thing. I'll switch off my video so that my audio will be clear to you all.
Yeah, sure. You can try switching off the video and continue the presentation.
Okay. So this slide was pertaining to quarterly result given by the company. So as we have discussed, if the company keeps on giving good quarterly result, meaning if the company delivers a good growth rate in its bottom line, that is net profit, we are good to have this company into the portfolio. So that is the one criteria which we should look at while tracking the company, and this company satisfies the criteria. If we can move on to the next slide, peer comparison. So as I have discussed that this company is controlling 70% market share in India for its adhesive segment. We went on to check if there is any other company of similar size or similar product listed on Indian Stock Exchange, but we did not find any company, and that is why the peer comparison is not possible. If we can move on to the next slide, future guidance given by the company. Now, we need to ensure that the company keeps growing at the same pace in future also. So for that, we will have to refer to what this company's management is thinking about the company. So, like we have discussed, that we will see the bottom line performance of this company or any other company that we want to track. So for that, we need to see what is the EBITDA margin guidance given by the management. So currently, if you will see, the company is giving around 20 to 25% of EBITDA margin, and the management is saying that the company will keep giving similar kind of EBITDA margin in future for next 3 to 4 years. Now coming to the capex, management is saying that we will invest 5% of our revenue in building further capacity. So it will invest in new factories, new plants, so that the company can manufacture the product and satisfy demand in the market. If we can move on to the next slide. Management. Now, this company was established in 1959. Okay, so the company has more than 50 years of history, and this is a family-owned business. So, currently, Mr. Madhukar Parekh is executive chairman of the company. One good thing about this company is that they have appointed one outsider as chief executive officer of the company to manage this company. Now, why they have appointed this person? So that we will see in the next slide. Yeah. So in the second line, I have given Mr. Bharat Puri's experience and qualification. So he joined this company in 2015, and he has previously held positions for 16 years in Asian Paints. So you can imagine the kind of experience that person has. He was there in Cadbury, which is known as Mondelez. The company's name is Mondelez and the company's brand name is Cadbury. And he was working in that company for 17 years. So he has more than 30 years of experience in managing companies on a consumer side. And that is why he has been appointed in this company, and he's working as chief executive officer of the company. Now, apart from him, all other directors and managers are very well qualified to handle such a large business. If you can move on to the next slide, shareholding pattern. So, in the first pie chart, I have given that promoters are holding more than 70% of the company as of the date. So it will give you an idea about how confident their promoters are. So if the promoters are holding less than 40 or 30% of the company, then it is a red flag or a sign that you can take it as a negative. But in this company, promoter itself are holding more than 70%. Now, uh, if you look at its domestic investors, we have found that there are two main investors holding more than 2% of the company. That is, one is LIC and another is Axis Equity Advantage Fund. Moving on to the next slide. Yeah, in this diagram and table, I have given historic shareholding. So the bottom line, I have given promoter shareholding, which was 69.61% in June 2017 quarter, and it has increased gradually to 70.19% in December 2020 quarter, which was the recent quarter for which the company has reported its shareholding data.
So I will
So
say,
here also we can see,
Hardik, this is an excellent sign that promoters have a lot of confidence in the future of Pidilite. And so they are buying their own shares from the market and increasing the promoter shareholding. So it meets one more criteria, I'll say, of promoter shareholding also.
right. Moving on to the next slide. Yeah, and I hope that my voice is audible to all of you. If you can confirm
Yeah,
with
it's
me,
better
Nehal.
than before.
Okay, great. So this is last 5 years performance of Pidilite as compared to Nifty index. So this chart starts from one, that is prior to 5 year. If Pidilite and Nifty was at same point, then how are they placed currently? So it says that Nifty, I mean Pidilite has overperformed Nifty by 1.5 times. So if you have received 10% CAGR in Nifty, then Pidilite has given 15% CAGR. And since this blue line is going up, it is trending up. It means that it has consecutively outperformed Nifty on a year-on-year basis. If we can move on to the next slide. Here I have given valuation details about this company. So this is a standard deviation chart for price to equity ratio of the company, and top extreme line and bottom extreme line suggests that these are the extreme valuation. So if the price to equity is trading in this range, there are high chances that either the company will consolidate for next few years or there will be price correction. And if we take latest day on which it was trading, the valuation was trading in the extreme most zone, that is between +2 standard deviation away from the mean to +1 standard deviation away from the mean. Now it is very technical language, but just to give an example, since the PE is trading at the topmost zone, we can expect that stock can either consolidate for next few quarters or it may come down a little. And by consolidation, I mean that price may remain within a range. within a range. It may not go up drastically from this level, or it may not go down drastically from this level. If we can move on to the next slide. Yes, so this is EPS and PE ratio table, which was shown earlier in first presentation. So in 2010, the company's price was 114 and company's EPS was 5 rupees. Now in 2020, the price was 1300 to 1400 and the EPS was 21 rupees. And if you take the recent date on which the stock was trading, the price was around 1600 rupees and my last 12-month EPS was 19 times, meaning that it was trading at a P ratio of 21 and now it is trading at a P ratio of 86. So if you take 10-year CAGR, price has increased by 28% year on year basis. EPS is growing by 12% and PE ratio is growing by 14%. So you have positive number in all the three categories. That is, price is also growing, profit is also growing, as well as P is also growing.
So this is that third, example where we are taken that the ideal company is where the stock price is growing because of growth in both EPS, and when the P expands, that's where you make a lot of wealth. So this is one example of a company where last 10 years consistently the EPS has grown at 12% CAGR, and same time the PE has also expanded. So PE was 21, now it's become 86, and so you are seeing such a huge increase in the stock price.
Right. And similar is the case even if you take 5-year CAGR. Okay. The price has grown, the EPS has also grown, and the PE ratio has also expanded. Moving on to the next slide. Now, what are the key drivers? Okay, we have seen everything, what the company is doing, what are its product, who is in management, how much percentage shareholding is with promoters, debt to equity ratio, everything. Now, in future, what will help this company to grow? So, as we have seen, the company is investing in this company by two routes. One is they are building the capacity of the company by establishing new plants and factories. Second is they are buying new companies in the similar segment, which for which they can sell the product. This company itself is dependent upon several other industries. Okay, the industries would be construction because the company is into waterproofing segment. So construction companies, real estate people will use this company's product into uh, building new houses. It is used in automotive, it is used in packaging sector, and it is used in several other industries. Now if these industries will grow, they will keep using Pidilite's product and Pidilite will also grow. What are the key risks for this company? One is the competition is increasing. Okay. The second thing is these paint companies are also, and we had discussed this point in our last presentation also when I was discussing Berger Paint, that Berger Paint has entered into waterproofing segment recently. Even Asian Paint is selling waterproofing chemical and products. So, how can this affect Pidilite? So, Pidilite is getting 20% of its total revenue from waterproofing chemical and waterproofing segment. So, going forward, the company is going to face high competition in this category. One thing is, as we have seen in the PE chart, it is trading at a higher valuation as compared to its historical price data. So that is also one risk which we are facing currently. One thing would be related to the market share enjoyed by this company. So Pidilite is already enjoying 70% market share in India, and to sell incremental product and generating revenue would be a little difficult for the company. So that ends my first presentation on Pidilite. Nehal, do you want me to take questions right now, or shall I first finish
Yeah, I think
my
we can
presentation
finish
on
the next company and then we can
Godrej?
have few minutes for question and answer. Yeah, we can just finish the next company.
Okay, okay.
मिस्टर सुरेंद्र प्रसाद के खून में एम्पायरिंग है कोई भी मौका नहीं छोड़ते पर जब असली मौका आया
एक्सक्यूज आप हमारे मैच में अंपायरिंग करोगे?
तब मच्छर ने इनको आउट कर दिया मलेरिया हजारों लोग मौके गवाते हैं और जाने भी एक भी मच्छर है डेंजरस इसीलिए काला हिट एक भी मच्छर नहीं बचेगा
किल मॉस्किटोज किल मलेरिया
मिस्टर सुरेंद्र प्रसाद के खून में
Okay, so as we have seen, this Kala Hit product was this segment itself was started by Godrej Consumer Product, and they are enjoying lion's share in the market. So my next presentation is on Godrej Consumer Product. We will see what kind of product this company is selling, what segments it is operating in, who are its promoters, shareholding, everything that we have discussed in previous slide. So this company is operating in four segments. One is personal wash, second is household insecticides, third is hair care, and fourth is air care. If we can move on to the next slide. Now these are its product. As you can see, personal care. In personal care, they have two brands: Synthol, Godrej Number One. They have recently launched Godrej Protect. In hair care, everyone, I mean, I'm sure that every one of you would have used products of this company at some point of time in history. So these are the various products that the company is having. Now, some of its products are synonym for the product name itself. Let's say you want to go in the medical store and tell that I want a mosquito vaporizer or something. You will tell them that I want a good night. So good night is sold by Godrej Consumer Product. If you can move on to the next slide. So this is regarding past performance of the company for its various segment. So I have compared FY20 and FY 2010 revenue, and as we can see, personal wash segment has grown from 838 crore to 2000 crore. Hair care has grown from around 400 cr to 3000 cr. Household insecticides have grown from 300 cr to almost 3000 cr. And the company has also launched a separate segment altogether under air care category. And we are using this product in our car or in our washroom or in our living room. Now, even if you take the percentage revenue derived from each segment, there has been drastical change. In FY 2010, the company was dependent upon personal wash category to the extent of 40%. Now it has come down to 22% as a result of launching a new category. If we can move on to the next slide. Now, let's talk about the future growth rate at which we are expecting this industry to grow. So, FMCG sector taken as a whole, we are expecting it to grow at around 9 to 10% for few years in future. Let's say for next 5 years. If we break it down in terms of household insecticides, which contributes around 30% of the revenue for the company, we are expecting that the market size is around 8,000 cr, and the expected growth rate would be around 6% for next 6 7 years. Within liquid vaporizer, that is, they are selling good night, and we are estimating that the market size for this product is around 2,200 cr, and Godrej is the leader in this category. If we take personal wash, So around 22% of the revenue has been derived from this category, where industry size is 20,000 CR and it is still expected to grow at around 7%. Now, what is leading to the 7% growth? Because a higher focus has been given on hygiene by the government and due to recent pandemic that we have come across. The next category is hair care. No, Pranav, if you can go to, yeah. Uh, in hair care category, the company is getting around 30% of its revenue, where the market size is expected around 3,300 CR in FY20. But the expected growth rate is huge. It is 17%. And the reason for this is because of increasing urbanization, evolving lifestyle, uh, growing trend for highlighting hair, etc.
Okay, so I think Hardik, the key takeaway from this slide is that whatever segments Godrej consumer product is operating in, like the household insecticides or personal wash or hair care, these segments are growing or expected to grow at 9 to 10%. Like you said, India's FMCG is expected to grow at 9-10%, which is more than the GDP growth rate. Okay, so that is very encouraging, that every segment which this company is operating in is in a growing segment, and the growth rate of these segments is equal or more than the GDP growth rate. And again, this company has a very dominant market share, like you said, in household insecticides, in hair care, and probably in personal wash also. Like you said, it's the second in the country today.
Yeah, that we'll see in future. Like I have included few slides on market share and kind of revenue they are getting from different brands. So if we can go to the next slide, Pranav. Yes. So this slide is about the company. So what the company is doing? Godrej Consumer Product is enjoying leadership position in many brands and categories. So if you take Indian market, okay. So first of all, this company is selling its product in many countries, not just in India. So if we take Indian market, they have 50% market share in household insecticides, and that will include your Good Night, Kala Hit, everything. Uh, if we take soaps, then it has 12% market share, and its brand Godrej number one is second largest player in India. If we take hair color, that is Godrej Expert, Godrej Nupur, they have 25% market share in India. Now, this company is also a leading player in Indonesia, and it is a leader in household insecticides, air fresheners, wet wipes. In US also, within wet hair care category, this company is number one. So there are various segments and market within which the company is enjoying lion's share. As we have discussed in our previous slide, that is one of our criteria to look for. Now this company is selling its product in 90 plus countries. So you can imagine the wide distribution network this company will have.
Okay, so
Moving on to
I
the
think,
next slide.
yeah, I think the most important takeaway from this slide is that in financial year 9-10, 77% of revenue of Godrej Consumer was coming from India. But now India contributes only to 54% of revenue. So 46% of its revenue is coming from the balance 89 countries which it is present in. So this is one Indian company which has grown so much globally. We always hear about global companies coming and setting up in India, but Godrej is our own Indian company, which is now present in 89 different countries, and 46% of its revenue is coming from outside India. And also the kind of dominance it enjoys in the household insecticides. Like you have rightly put that 50% market share in household insecticides. So Good Night brand, Hit, all these brands. Again, in toilet soap, it's a number two player. Hair care, it's a huge market, and occupying a 25% market share also is pretty huge. And even like I see in a country like USA, it's leader in the wet hair care segment. So it's phenomenal.
Yes, I mean you can just imagine the brand itself is a synonym for the product. Moving on to the next slide. So when we look at what are the brands enjoying leadership position in India as well as abroad, so these are the 9 to 10 brands having number one position in its respective segment. So Goodnight is number one in liquid vaporizer. Godrej Expert is number one in India when it comes to hair color. Darling is number one in hair color when it comes to Africa. Godrej Air, which is the recently launched category for air care segment, is number one when it comes to air care. It has several other brands which is at number two position, which is Godrej number one in soaps, Synthol. Uh, these two are in India. The other three brands are in abroad. So they are, I mean, they are enjoying leadership position in most of its brands. Moving on to the next slide, there are three brands from which the company is getting more than 1,000 crore each. That is Goodnight, Darling, and Godrej number one. Uh, as you can see, there are other brands where the company is getting more than 500 CR revenue, more than 250 CR revenue from single brands.
Okay, so one question here, Hardik. What is the total revenue of Godrej?
The total revenue would be around 8 to 9,000 CR. Pranav, if you can move on to the past performance of this company. Yeah,
Okay, so
the
9,000,
FY20 revenue is 10,000 CR.
So what we understand that 10,000 crore is a revenue, and there are few brands which are 1,000 crore plus brands, and a few brands which are 500 crore plus. So maximum out of this 10,000 crore is coming from these 8 9 brands only, which are so strong brands that in future having a threat on these brands is a little unlikely in the immediate future. Is what I understand from that slide where. Uh, 8 or 9 brands are contributing to such high amount of revenue. Pranav, you can go back to that slide of brands contribution. I think
Yeah.
the previous one.
So as rightly put by you, around
Go to the previous slide.
70% of the revenue is coming
Pranav,
from
previous
this.
slide.
So around 70% of the revenue has been derived from this top 10 brands. Uh, Now about this company, this is a 120-year-old company with a patronage from more than 1 billion consumers globally. It is following 3 by 3 approach, meaning it is focusing on three segments and three regions. Which are these three segments? Home care, hair care, and personal care. And which are these three regions? Asia, Africa, and Latin America. So if someone has this a company in its portfolio, then if they will look at the quarterly performance of the company, they are giving these numbers that how much revenue has been derived from home care, how much revenue has been derived from hair care, etc. And how much revenue has been derived from Asia, Africa. What we need to do is to just track these segments and to see if these segments are growing, and if these segments are growing, the company is good to be part of the portfolio. Now, some recent developments. In past 2 years, the company's launch of new products has doubled as compared to its previous 2 years, which means that the company is spending good amount in R&D, and in future also the revenue will keep showing good growth. The company has reached to around 66,000 villages, and it has its product available in more than 8 million outlets in India, which says that the company has very strong supply chain management system.
So, Hardik, what I understand that the government's focus is increase in the rural income and the farmers' income and all. So if there is a growth in rural India, then Godrej Consumer Products should benefit out of that, given that it is currently present across 66,000 villages in India.
Correct. Moving on to the next slide. So these are its product in household insecticides category. So as we have said that the company is enjoying 50% market share. So which are its products? So the company has its product in various sub-segments, like in burning also they have several products. In aerosol sprays, it has several products. In electric vaporizers, it has several products. And these are based on liquid as well as any other forms. Moving on to the next slide. In personal category within household insecticides also it has a few products. In they have also launched some product based on natural ingredients, meaning it is made out of neem or any other plant or something, and they have launched several categories within naturals also. Moving on. The goal for the company based for this segment is to drive penetration in lower price points as well as to premiumize some of its product and meet a consumer's demand based on changing taste and preferences. And based on this only, they have launched its product based on natural category. Out of this, liquid vaporizer is the largest and most profitable segment. Moving on to the next slide, this is a hygiene portfolio for this company. So this brand was recently launched by the company known as Protect, and these are the products available within the Protect brand. And they have kitchen protection, personal protection, and home protection. Three different sub-segments within this. If we can move on to the next slide. Yeah, these are the brands available in other countries apart from India. Like in Indonesia, they have Senator brand. In other country, they have Stella, and I guess they have recently launched Stella in India also. Because of growing demand for sanitizer due to this pandemic, they have received a very good response for all these products. Moving on. Let's look at now. These were the product and market share of the company. Now let's look at past performance. So revenue has grown from 8,400 CR to 10,000 CR as of FY19, and in FY20 there was negative growth because of the company was hit by pandemic in last quarter. If we take debt to equity ratio, okay, so it was very high in 2016, around 70%. It has come down to 40% gradually in FY20. So the company is managing its business in a very well manner and repaying its debt from it has reduced it from 0.7 to zero point 0.4. PET margin, if we look at PET margin, it is growing. It was 9.8% in 2016 and 15% in FY20. ROE is around 20% for all the years. Like in FY16 it was 19.3%. It has grown to around 34% in FY19, but in FY20 because of pandemic it has come down to 20%. Looking at the last table, its profit has given growth rate of 10% for last 5 years, and average ROE has remained at 25%. So 25% is much higher as compared to cost of capital for any company. If this company will go to any bank and ask for a loan, the percentage would be around 10%, 12%, 13%. But as compared to that, this company is making around 20% on its capital. Moving on. These are the recent numbers. So Q3 result is yet to come out. So we have taken Q2, that is September quarter numbers, and as we can see, for revenue, it is given 10% year-on-year growth rate, and for profit, it is given around 22% growth rate for profit before tax. The net profit margin has remained around 16%.
So,
As we have seen that companies,
yeah, Hardik. So what we conclude that in the last 2 3 quarters, even in pandemic, this company has done good. I think because of increasing focus on hygiene and personal care and all. Am I right to infer that looking at the
right,
quarterly numbers?
right. And as we have discussed that the company is focusing on three by three approach. So that's where I have given the tables for its operating segment as well as its regional geographic segment. And as we can see, the personal wash category has given 20% growth rate for for quarter two FY21, which is very high. And even looking at the segment, the Latin America segment has grown by 41% as compared to the previous year similar quarter, which is phenomenal. Moving on, promoters. So Godrej Group is a promoter for this company, and this conglomerate was established way back in 1897. And as we have seen, it is enjoying patronage from more than 1 billion customers globally. And the company's revenue itself is for the promoter group revenue as a whole is around $4 billion. And this group has its company in various industries, that is consumer side, real estate side, agriculture side, and various other industries. Moving on, leadership team. So recently there was a change in managing director, and Nisaba Godrej, one of the family member of Godrej group, has taken over as managing director for this company. So Nisaba Godrej was part of this company since a long time, and she has done BSc from Wharton School and MBA from Harvard. So she is well qualified and has good experience within consumer side of business. And rest all regional heads have very good experience. They are MBA. They have around 10 to 15 years of experience in consumer side of business. So that is how we have done management analysis. And one criteria would be promoter shareholding, which we will see going forward. Moving on. So promoters are having 63% shares in the company, and apart from that, financial institutions, foreign financial institutions have around 27% stake in the company. If you look at individual shareholders apart from promoters, then Baytree, which is a Mauritius-based fund, is holding more than 2% stake, along with First State, which is holding 2% stake in the company. Moving on, peer comparison. Now, since there are a lot of FMCG companies listed in India, it was possible to do peer comparison, and we have put several tables in front of you. So, if you look at market cap and sales and profit, the Hindustan Unilever is the biggest company as compared to any other FMCG companies in India. When we look at past growth in profit and sales, we found that Hindustan Unilever and Marico are leading in sales growth, and HUL is leading in profit growth given historic data. Moving on, Margins. So last 5 years, operating profit margin or EBITDA margin was highest for Colgate Palmolive, and if we look at operating and leverage ratios, so cash cycle was negative for Hindustan Unilever. The lower the cash cycle, better for the company. So if it is negative, that means the company is first collecting money before supplying its product, which is a very positive point for any company to have. So HUL has negative 15 days as cash cycle, and if you take debt to equity ratio, it is almost zero for all the companies, with Godrej Consumer at 15%, which is also considered to be very low. If you take cash flow conversion, then out of 100 rupees of profit, HUL is uh, saving 92 rupees even after meeting all the expenses uh, from the revenue and capex requirement from the profit. And the same number stands at around 70% for Godrej Consumer, which is considered to be a very high number. Moving on, profitability. So for last 5 years, Hindustan Unilever has given average ROCE of 108% as compared to 20% for Godrej Consumer Product or 29% for Dabur. Promoter shareholding, of course, all the companies promoters are holding more than 50% stake in its respective company. But in HUL, we have seen that in last 3 years, promoter stake has come down by 5%, which is not the case with any other company. Moving on, valuations. So here we have seen that Godrej, Marico, and Colgate are trading at uh, cheapest valuation amongst the peers. And the similar is case with when we compared price to sales ratio for these companies. Price CAGR. So how much returns are delivered by this company for the investors? So for past 3 years and 5 years, Hindustan Unilever has given highest return. That is for last 5 years, they have given 23% CAGR as compared to 14%, or I mean, most of the companies are pertaining to 13 to 16% band, whereas HUL has given 23%. Moving on, now our view. So this company is a little different from other companies, meaning that other companies have its product in mostly in personal care category, whereas Godrej Consumers' primary focus is on health and hygiene and insecticides category. So in those categories, this company has a very robust portfolio, very good product. The brand itself is synonym for the product. Is that it has several power brands, as we have seen that 70% of the revenue is derived from top 10 brands. Its focus will remain on three regions: Asia, Africa, and Latin America. And it doesn't have any significant capex requirement. And it is doing expansion both by way of establishing new plants and by way of purchasing new companies. And we have seen that Godrej Consumer Product has made several acquisitions in past. And the very good point for this company is that valuation is reasonable when we make peer comparison. Moving on, this is the price comparison as compared to Nifty. And since the blue line is moving up for last 5 years, GCPL has outperformed Nifty indices.
Pranav, you take the cursor to the lines which Hardik is saying for people to understand this better.
Yeah, so the straight blue line is trending upward. So that means that for past 5 years, the company has outperformed Nifty. Moving on, this is uh, how the industry has performed as compared to Nifty and how the company has performed as compared to the industry. So the blue line is pertaining to the industry as compared to Nifty. And since it is trending slightly downward, so industry as a whole taken together has underperformed Nifty. And since this red trend line is also moving downward, so Godrej Consumer Product has over last 5 years underperformed its peers that taken as a whole, that is HUL, Dabur, Marico. Moving on, valuations. So here also we felt that valuation is at extreme high level, trading in its highest band. And now I guess you all will understand very well what this chart suggests. Moving on, this is EPS and PE comparison. So this is a similar table where price has grown from 87 in 2010 to 745 in the recent week. EPS has grown from 3 to 14.94 and PE ratio has almost doubled from 23 to 49. So in all fronts, we are getting positive CAGR. And
So I think we found one more company in that bucket one category where this company's stock price has grown by 22% compounding rate for the last 10 years. And out of that, 22 contribution from EPS is 14%. So we are given one example where EPS is consistently growing at more than 10%. So this company's EPS has consistently grown more than 14%, and the PE from 23 has become 49, so almost double. So here is again one company where stock prices gone up both because of EPS growth and PE expansion. So again, a double benefit is what we are seeing, and so stock prices gone up from 87 to 745, almost like 8 9 times in the last 10 years. And looking at what presentation you gave about the future, that it is operating in 90 countries right now, it's number one in the household insecticide category, number two in soaps. It's come up with the new category, which is like the air category. All that shows that probably the future growth prospects in the next 5 or 10 years also look pretty strong for this company. Yeah, you can
right.
continue, Hardik.
Yeah. Moving on, what are the risks related to this company? So one is high valuation as compared to its own historic valuation. As we have seen in last 10 years, the PE itself has doubled. Second is intense competition. So we can see a lot of players within all the sub-segments. Third is high chunk of revenue is derived from abroad. So any adverse effect on exchange rate may affect profitability of the company. Fourth is related to recent change in managing director. Since a new MD and CEO has taken over, it will be worth watching how the company uh, does going forward. And the last and foremost is the intangible asset. Since the company has done a lot of acquisitions, so while going through past accounts of this company, we have found that 50% of total assets are intangible in nature. That is goodwill or brands. And if any adverse event happens, the company will have to write it off, and that may affect profitability going forward. Moving on. So that ends my presentation on both the companies. Uh, I invite questions from all of you, all the participants.
Yeah. Pranav, we can just move on to the slides of Finovate. In meanwhile, I'll just suggest everyone to ask questions if you all have for Pidilite and for Godrej Consumer Products. Hardik, Naveen, and other people from our team are all on the panel right now. So whatever questions, and the questions need not be necessarily for the two companies we presented. It could be for the first presentation also. If you have any questions, either you can like type in Q&A or in the chat. Okay. If someone from the team can start shortlisting the questions which people are writing, and address that questions to Naveen, Hardik, and others. So in the meanwhile, Pranav, can we go to that slide about what we do at Finovate and how we can help people by helping them build a long-term portfolio? Yeah, so I'll just take a minute to summarize that we at Finovate are on a mission to democratize financial freedom. At the end of the day, we all make investments so that we reach a net worth of 8-10 crores through which we can generate a passive income. And how do we do that? We basically help you learn about various aspects of personal finance. We help you make a financial plan for yourselves. Then we help you implement that plan and then track it. So every year we track that how much is your net worth growing? Are your debts getting paid? Are you investing rightly as per your goals and asset allocation and all that? So this is what we do at Finovate. We are SEBI registered investment advisors. Moving on, so basically, what we do is that we help people generate a 3 to 5 lakh rupees a month of passive income. Yeah, Pranav, we can just move on from this. So all the people who are over here, Pranav will just be sharing one link in the chat right now, which will help you to get a 30-minute free session with our certified investment advisors, where you all can discuss what your current net worth is, what are your liabilities, and if you want to make a financial plan which will help you to pay all your liabilities plus build a net worth of 8-10 crores through which you can get a 4 to 5 lakh rupees per month of passive income, or whatever income you are looking at. In the next 10-15 years we can help you to build that portfolio which will give you that passive income. So he's posting a link in the chat. You can click and book a session. You will get a complimentary ebook about today's session, the whole summary of today's session. So a lot of people are writing, can we get takeaway or a summary of key points? So we will share that with you in an ebook. Yeah, so now we are open to questions. So people from the team, if you all have shortlisted questions, can you all just ask right away?
Okay, there's a question from Mr. Milan Shah. Hello.
Yes.
What are your views on various investment styles such as growth, value, momentum, dividend investing? What is suggested for retail investors?
Naveen, you would want to take this question?
Yeah. Sir, the different styles, as you rightly mentioned, there are different styles. So there is no study done as per which one is better or which one is worse. Normally, people, there are different kinds. So growth, dividend, value, and then there's a concept called growth at reasonable value. So there's not that one style is better than others. It must meet your investment criteria. For example, if you are very young and you can have higher risk appetite, you can go for a say growth oriented strategy. But if you are nearing your retirement or you need your money for your running your expenses, then maybe the value or dividend kind of investing works for you. So that depends on individual circumstances. But at the end of the day, in either of the strategies the Nehal discussed in the first presentation, the company has to be fundamentally good, irrespective of the style. The style is the second aspect of the investing. The first aspect is the getting to invest in the right kind of business. Style can depend on your life stage, your risk appetite, your experience in the market, your understanding of the business. For example, I will give you a very famous example. Warren Buffett, who is known as the value investor, the best value investor in the world, he never invested in technologies company for the long time. So the only reason is that he said that I don't understand technology companies. So I will not invest in the companies where I don't understand. So the investment style will depend on your personal circumstances, your understanding of business and markets, your time to the goal, your risk appetite. But the essential point is do whatever you want to do, but first make sure that the company that you're investing in are worth investing in those businesses. Hopefully that answers your question, sir. Can
Okay,
we take?
there's a next question. Uh, just hold on.
Yeah.
How one can identify the bottom out or topmost level of any stock for purchase or sale? This question is from Mr. Manoj Khandelwal.
Manoj sir, this bottom out and top is like Nehal mentioned, there are two types of analysis that you can do on stock. One is called the fundamental analysis and one is technical analysis. The words you are referring to are more so used in technical analysis, bottoming out, topping out, where there are certain kind of chart patterns which people have formed over a period of time, and they have come up with those terms to identify a particular phase in that stock's life cycle. But like we discussed, what we are focusing here right now, understanding the companies on the fundamental side of it. If you are interested, we can have like a webinar where we can deal with the technical analysis part also, and there we can discuss those patterns in details. But they are mostly referred to technical analysis, where we bottoming out means the stocks have fallen to a level where more people are willing to buy, and they are based on various different criterias like moving averages, last bottom, double top, and all those terms, but they're only used in technical analysis. They have nothing to do with the fundamental analysis, sir. Please post if you have any follow-up question. Next,
So
Jignesh.
there's one question from Mr. Dharmesh Dubey. What, according to you, shall be the ideal portfolio allocation?
So Nehal, I think answered this question. So portfolio allocation, I think you mean to say overall portfolio allocation. So there is like different ways to look at it. So there is a thumb rule and then there are specifics. So thumb rule is that like your age minus 100 minus your age should be your equity allocation. So suppose you have 100 rupees to invest, and if you're 30-year-old and if you have decent risk profile, you can invest up to 70% of your money in equity markets. So obviously as your age increases, the proportion of equity in your portfolio decreases. This is on the overall portfolio level. But I guess you might be asking about the individual stock level. Then Nehal said that like more or less the allocation has to be like within the equity, you have to make different baskets, like the four quadrants Nehal demonstrated, like there are certain kind of companies which are in this segment. And suppose if you have a portfolio of 20 stocks or say 15 stocks, so average allocation works around 7% to 10 or 12% is the maximum side. Don't overexpose your portfolio in one stock more than or less than that. Then it doesn't make sense.
There is one question on Pidilite. So he's asking that what is your call on Pidilite? Shall we add at a regular interval?
So like this webinar is only for learning purposes. We are not recommending stocks, but as a strategy, that is what we recommend to our regular clients, that the one stocks that you have identified and that those stocks must be invested in a regular manner.
And
So
I believe this will also be dependent upon their individual investment
That's
purpose.
yes.
So if they have longer horizon, then definitely it can be added in the portfolio gradually. But if they have short horizon, then it's kind of difficult.
For short horizon equity is not recommended only. So that we
Right.
can completely leave aside.
Someone has asked this question, that is technical analysis better or fundamental analysis better when picking up stocks? So I'll say that I began this presentation saying that if you're trading, okay, then technical analysis is important because you have taking short-term decisions to buy and sell, and you're looking at short-term profits, and that's where the chart and the levels, the stop loss, target, double top, double bottom, Elliott wave, and whatnot, all comes into factor. But when you're building a portfolio for long term, 10, 15, 20 years, you have to focus on fundamentals because uh, technicals really change with like COVID happened. Suddenly a bullish market became bearish when I look at the technical charts. Okay. So in short run, it changes a lot. But in the long run, maybe for 3 quarters, the company's EPS may go down because of COVID lockdown and all. But over a 10-year period, if the company is good, its EPS will grow. So if you're building a long-term portfolio, focus on fundamentals, focus on the EPS growth, and focus on companies where the sales is growing. There are many brands and the management is good. The next question. I think someone has just asked a question that if the
One
valuation
person.
of a company is high, for example, TCS and HUL, what should be the action of a retailer?
Just so valuation, like Nehal described in the presentation, the valuation is multiplier. So the stock price that you are referring to is multiplier of EPS into the PE. So what you mean to say is PE is very high. So what should I do? So again, the fundamental question remains, based on your time horizon, you have to focus on the EPS growth. So if you still believe, or as your understanding, you still believe TCS EPS will keep growing over a period of time because people are shifting to technology, more and more people are investing in the technology. And if you think that TCS is in the right position to take those opportunities and grow their business, then I don't think there is any action required just because the price has gone up. Well, because if you remember, we are in the month of January. If you go back, like Neil described that in chart, if you have asked this question last year during the pandemic, the EPS didn't change. The P keeps changing. So last year January versus last year February versus this year February, the P has changed a lot. But what you have to focus on, what is the view or the growth prospects of the EPS over the next 10 years? And that is applicable to somebody asked about the different styles of investing. So even if you're investing in a growth oriented company, a value oriented company, or a dividend paying company, even if, how the company will pay the dividend, only if there is a growth in EPS. How the company will be called a value company, only if there is a prospects of EPS going up. What is a growth company? The growth company simply means that the earnings are growing at a faster rate compared to the other peers in the market or the other industries, and hence that company or that sector or that industry is in a higher growth phase. But the bottom lines in all three remains the same. There has to be a EPS growth over a period of time.
Okay. One question someone by the name of Smith is asking that, hello panelists, small question. The market is falling from last week. It is already down 6-7% from high. Can we invest more now, or this downtrend may continue and we have to be cautious?
So the levels, the short-term view, the 7 days, the 1 month is better answered by the technical analysis. So then you'll have to look at the charts, individual setups, various factors. But in 7 days, if there are no material changes in the company's fundamentals, like if there is no major change in the way a company operates the business or the growth prospects, then obviously, and if you're building that company in your portfolio for a longer duration, why not?
Yeah, so I think the right way to look at it, that if you're going to build it in SIP every month,
Yeah.
then it really doesn't matter if the market is down 5-7%. You are not putting the entire money right now. You are buying that company over the next few years, little by little. So I don't think you should be too worried about the valuations. One more question from Mr. Dinesh is that ideally we think debt to equity ratio should be 2:1. Two cheaper source in profitable capex, which will increase value and share price. So I think he's asking that, high debt
Yeah, yeah.
is good for the
Two is
company because it's a
two is
cheaper
the
source.
higher cutoff. Two is the cutoff used by banks to determine should I lend it to this company or no. But if there is a company which requires very high capex, but then there are alternatives where the companies require low capex, then it is a choice what kind of businesses you want to invest in. Like most of the examples that we like in the examples uh, of Godrej Consumer or any other company, many companies we have quoted in last year, they don't require huge capital to grow. But that is a different case with, say, a cement company. So that's what you're referring to. Maybe the cement company, the steel company, they require huge capex to grow their business. But then there also, you have to be then like to what you mentioned is the ideal or the highest allowed for a normal. So if it goes beyond 2, there are other risks involved in that company. So you have to be careful when the company reaches a threshold of 2, but the obviously lower the better.
Okay. Dr. Aditi Tandon is asking, can we enter markets when markets are at an all-time high or wait till it corrects? And at how much loss do you recommend exiting a stock? So I think there are two parts to this question. On the first question, that when do you enter the markets? Like, is it okay to enter at all-time high or wait for corrections?
So enter the market is very, very tricky word, because why that, like, if you're meaning the lump sum, putting a large lump sum amount, that I consider the entering the market. But if you're an existing investor of, say, your portfolio is say 2 lakh rupees and you are buying another 20,000 rupees, it doesn't qualify to be called entering the market. So when you're entering the market and you are putting some money from, say, a fixed deposit to equity, or you are the first time investor and you are coming at the highest level in the market, then that is considered entering the market. But if you are existing investor in certain stocks, you have a decent amount of portfolio and you are buying this additional 5 and 10% of the portfolio, that is like buying at a regular interval. So it depends what kind of investment you are going to make. If it is a lump sum invested in a very large amount compared with your overall portfolio size, then these things obviously matter. You have to, be careful about putting a large sum of money when the markets are on the higher side. But if you're putting only a 10% or 20% additional capital at the current level or any other level, then it is a different story. What was the
Yeah,
second part of the question,
like
Nehal?
if anyone is doing SIP in direct stocks every month, then
Right.
levels don't matter. And to answer the question that when they should put lump sum, whenever they see the index falling more than 15-20%, that is where they can put lump sum. Otherwise, irrespective of the market level, they can continue that discipline of SIP in direct shares, like they do it in mutual funds also, irrespective of market levels. The
Okay.
second question was that at how much loss do we recommend exiting a stock?
So, exiting a stock at a loss, again, like we started the presentation in a manner that there are 2 types of analysis, for trading and for investing. So in trading, you have to exit at a loss, stop loss and all that thing. And that is based on some technical indicators. When we talk about exiting at a loss, when we are considering a fundamental analysis, or the approach that we have demonstrated over the last 2 hours, 2.5 hours, is when the business fundamentals change. For example, like Nehal rightly pointed out the example of, say, Bharti Airtel. At one point of time, Bharti Airtel and Vodafone Idea, which is legend, were the very, very high growth stocks, including the Reliance Communication, which was listed at that point of time. Then, but due to the change in the business fundamental, the government rules changed. The way they operate in the market changed. The 3G auction, the 4G auction, all the rules of the games keep changing. Then there came a new entrant called Reliance with his Geo offering, and the competition in the market increased so much that rest is the history. You know the history of telecom sector in the 5 years. So during that phase, you could have analyzed the stock saying that, okay, the business fundamentals of this industry has changed, so I should book a loss and exit the industry or exit a particular stock. So that is how you look when you invest in a company on the basis of these fundamentals. And they do change over a period of time. Like nothing is sacrosanct over as a 10 or 20 years period of time. And that's the reason we normally say that invest in the companies where the investments required are lower. So if you look at the business model of Airtel or Vodafone or Reliance or any company in telecom, one, they are dependent on government policies, and 2, they require huge investments in infrastructure. Somebody was pointing 2:1 debt equity ratio and all that thing. But there are many other companies which don't require much of the investment, like your IT companies, your FMCG companies, your consumer durables like Whirlpools of the world. They don't require that big investment. So again, it boils down to the specific company's fundamentals. If they change over a period of time, obviously you have to exit that stock. But there's no particular level at a 10% or 15%. That is applicable only if you have bought or sold the stock on the basis of the technical analysis.
And like we had said in our presentation, that if you're building a 20 stock portfolio, it's no way that all 20 companies will give you profits.
Yeah.
It's
You will
very
end up buying a
likely
Airtel.
that
Yeah.
five companies you will lose 100% capital. So there is no level, like even if it's 50% minus, if you feel that no, this business is not going to do good in future, you take that 50% out and put in a company which is growing or doing better. That way you will recover that 50% downside also in a performing or a better company. So it doesn't, you have to again take this decision on a portfolio level. If I had put 100 rupees in a portfolio, is it growing at 110, 15, 20? Out of that, a few companies are red and green will not matter. If the red companies you feel that future is not good, exit. Doesn't matter how much loss you're booking. It's money. That money you can take and put it in better companies.
So the classic example is Nehal, again, the pharma industry that you mentioned in your presentation, that till 2017 it was growing at a very rapid pace, but suddenly so few things changed in the international market, the US FDA issues and all. So growth rates slowed down and hence the prices corrected. But the as an industry as a whole, if you think pharma, forget about the COVID and post-COVID environment, even 3 years back, the business fundamentals are still strong. They still had the access to market. Only thing they were facing was the pricing issue. There are no external threats to the business. So it was not as if that some new companies coming and going to replace existing player like a DRL or a Lupin or any other company. Neither people are going to consume less medicines over a period of time. So in those difficult times, you have to go back to the fundamentals and analyze each factor affecting that particular company and then take an informed decision based on those factors.
If team people have shortlisted some questions, you all can just ask now.
Someone is asking where to find company management details. So there are three sources. One is company's own website. You can go there and you can refer to about the company and leadership team and everything. Second is from company's own annual report. So whichever latest financial year report is available, you can go there and find details in the report. And third is regarding the promoter shareholding. So that detail is available on Screener website, screener.in.
Or any other financial website, money control and anything.
Right.
Next question, if people have shortlisted.
What is your take on passive income through direct marketing with low investment? I guess he's asking direct equity with low investment. Dr. Neeta Patnaik.
Okay, I understood that question a little differently. I think she's asking, those direct marketing MLM kind of a thing where you invest low and you get a passive income. So I'll say that is out of the scope of today's presentation. You can invest in direct stocks of good companies which give you more than double digit CAGR. So in 15-20 years, you reach a substantial net worth through a direct stock portfolio, and from that you can get a passive income or something. So I'll answer that question in that way.
Uh, One person is asking, can you please summarize all different parameters with good value range for selecting different company stocks in one slide?
I think Hardik, you can answer this question.
So probably what we can do is we can put one slide in the presentation, like what is the range of ROE or what is the minimum ROE we are looking for, what is the growth rate we should
So
expect
that I
from a
think Nehal
company.
discussed in that presentation that the key criteria of core businesses, the dominant market share. So you can put it in a slide, but the same things remains the same for. So
The same thing is
the
there,
core
right?
business, the dominant market share, then the ROE cutoff of say around 15%. Profit growth must be higher than the annualized GDP growth rate. So we companies growing at say our country GDP is growing at 8% plus there is 4 or 5% inflation. So companies should be at least growing at a profit rate of say at least 10% or higher. The higher the better. in valuation, like we discussed, the valuation keeps changing. It's nothing is constant. So I have to, if I look from that criteria, I have to focus on the EPS growth, P growth, and only if I'm saying that P is on a higher side, I will not make a fresh investment in that stock, or maybe wait for the correction. But that depends on what is your portfolio size, how much exposure you have with that stock. If that stock is only 1% of your portfolio, obviously you can go and buy more of that stock, same stock. So these 4 or 5 broad criteria can be summarized in slide, right? And the slide, and we can email to the participant if they want.
Right. One person is asking, can you please suggest what will be the best industry oblique companies which are undervalued or fairly valued as on date, as of today?
So this is again subjective question, sir. And this is not the purpose of our exercise, that to identifying the fairly valued and lowly valued company. The only point I think it made again and again we are making, that you have to focus on the company's business and its growth prospects. Valuation and all is dependent on many factors, and when I say many, it could be like hundreds of factors: GDP growth rate, industry cycle. Like I said, pharma, there are different criteria to evaluate pharma companies. There is different criteria to evaluate a steel company. So if you consider a steel company that are available of a PE of 5, 6, 7, whereas a HUL is available of PE of 60, then how do you make your judgment that which is lower and which is higher? So as a industry specific, you can't consider cross industry valuations. It doesn't make sense, because there will be one industry which is available at a 6 and 7 PE and growing at a nominal rate. What are the similar industries where the capital requirements are low? Their valuations are very, very high. Look at the stocks like forget about India, even globally, the technology stocks are now very highly valued. But whereas a steel company, a cement company, a road construction company, a capital goods company, they are not valued high. So I can't compare one with the other on the valuation parameters on a growth level and on a particular stock level. You have to go down from that bottom up approach that we recommend. Study the company first, understand the company first, and then look at the other aspects. The top down approach of comparing industries and all is not a recommended stock advice or anything like for a strategy for any retail investor. That's for highly sophisticated investors who have thousands of data points, hundreds of analysts, and hundreds of sources to know those all information required to take that kind of call.
One question which
So stick to B2C businesses. While like Nehal mentioned that for retail investors, for DIO investors who want to start in the equity, understand equity, stick to B2C businesses where the capital requirement is low. Hence, there will be low debt equity ratios and decent growth prospects. Means the profits are growing at a faster pace than the GDP plus the inflation kind of numbers.
Okay. Dr. Aditi Tandon is asking that is the CAGR same as XIRR? I think few people had this question
Yeah.
last time
So,
also.
Dr. Tandon, CAGR refers to point A to point B. So suppose if you make one investment and then you compare the one withdrawal, it is called CAGR. But if you have multiple investment, like in a mutual fund, you have a SIP, which goes every month. So every installment will have a CAGR as of today. Because current value is only one, but the investments value could be many. There could be one investment or multiple investment. When there are one investment and one today's value, CAGR and XR are both same. But if there are multiple investment, each investment will have its own CAGR. And as of today, the XR give you the average return on all of those CAGRs combined. So for SIP investment, it is XIRR. For lump sum, it is always CAGR and XIRR. Both are same.
Okay. Dr. Aditi's question is that how can she know the portfolio level CAGR, because it is not given anywhere? I'll say to answer this question, maybe we can just put whatever money you have invested in equity over a few years or months, and what is the current portfolio value.
Yeah.
Basis that in an Excel sheet also we can calculate the XIRR or the CAGR of portfolio.
Yes.
So even if
Yes.
any app is not giving you, by formulas in an Excel sheet, you can calculate that. Maybe someone from our team will reach out to you and help you calculate the portfolio level, IRR or CAGR returns.
Yes, yes.
Sir, there's one question that does Finovate help in building portfolio consisting of companies which are listed in America?
So we do have a platform where which we have facility to buy and sell companies in markets other than India. But as a advisory, as per our the SEBI license, we are the primarily it's a company for domestic investment and advisory front. But we do have a platform and we can help you build a portfolio across the globe.
Any more questions? If anyone from the team has shortlisted, else we can wind up this webinar. As someone is asking me, how do you get money by conducting free webinar? I'll say that we are not doing this webinar for any kind of monetary gains, because what we realized, spending 2 decades in the market, was that why people are not getting the kind of compounding return which equity market has given is because of lack of knowledge. Even if we make a financial plan for them, we tell them to do SIP in mutual funds or stocks. Whenever there are market, ups and downs, people stop their SIPs, or they withdraw their, investments from stock market and put it in real estate, and they take random decisions. So the only way you can change this psychology is by educating them. And so we really focus a lot on the learning aspect or the education on personal finance, because when you are educated, you know that these ups and downs will come, and when there is a dip, it's a time for you to buy more. So we really are not looking at any monetary gains from the webinar. Like one person had just wrote that he got very inspired by today's webinar to start investing in direct shares. I think that is our reward. If we can inspire even a few people to start building a direct stock portfolio and keep investing for next 10-15 years, and if they can really create wealth out of such style of investing, I think that will be a very big reward for us. So I will say that the only reward is that you spread the word about our webinars. You can invite your friends, share the links of our webinars with people, and if we can reach out to as many people and help them understand the basics of personal finance, that will be good for us. So if the team has any questions, it will be like good, we'll answer, or else I think we can wind up the webinar. Okay, I think we have already 2:15 now. There will be webinars in future. So next time we will cover a different topic in, say, different companies in different sectors. A lot of people have told us to do webinar on mutual funds. So we will come up with webinars on mutual fund, where we will have a look at the complete mutual fund industry of India. What is the size of the industry? What are different schemes? Or when you should choose what. So please join the link of our future webinars. That will keep you updated. Lot of people have come back and told us that we have a lot of debt. So we want a webinar to understand how we can become debt free very soon. So we will come in future webinars with like good data, where if you are paying EMIs or you are having debt, then how you can reduce your interest cost to half, and become debt free very soon, by like very simple hacks. So maybe in the future webinars we will come back with that. In meanwhile, I do understand we could not answer a lot of questions because there were many questions. I'll say that, Pranav, if you can just put our email ID in the chat, people can write their questions to us, and we will just try and answer those questions, email it back to you or get in touch with you. So please just type the email ID in the chat, and we have a list of your questions, and we'll try and write it back to you. So you can take our email ID and send us whatever questions you all have. Yeah, can we just get the email ID? I think he's put the email ID. So please, y'all can write your questions to us. Once again, thank you so much to everyone for making this second webinar also a grand success. We look forward to your support in the future webinars. Thank you so much to the entire Finovate team, Hardik, who has done such detailed analysis on Pidilite and Godrej consumer product. Thank you to Pranav. From the start to the end, he has ideated the entire webinar and put it. So we are just the face coming and talking. He's actually in the background doing all the work. Thank you so much to Naveen. He helped me put through the first half of the webinar. And I'm really thankful to all of you. Like, I think we've overshooten for more than an hour and 15 minutes. Still, people are there and they think that it's worth their time on Sunday. So once again, gratitude and thank you to everyone. Thanks.
Many thanks to everyone. And we'll see you soon.